Now it's your time. Almost my work is done. I have recorded three theory chapters also, and the weightage of these three theory chapters is 18 marks. Okay, my work is almost done. From my side, I'm going to upload bullet MCQs SFM. Okay, so only that was pending from my side. So once again, I'm reiterating. So please do practice each and every question given in Super 50 PDF. Okay, and Smart 35 questions also if time permits. The sources you have to rely on. First one, the marathon which was uploaded 1 year ago. So that is enough. Plus Super 50 video, Super 50 questions explanation video, and this theory video, and I'm going to upload bullet MCQs video. So, okay, do rely on these videos, and I will be waiting for your results which are going to declared on August 21st. So eagerly waiting for your messages. So thank you so much. Thank you all. Without wasting time, I'm going to start theory. Thank you. And do not take practical questions also light. Of course, theory is important, and practical questions also. Whatever the questions I have given in Super 50, please do practice. Thank you.
Hello, hi everyone. Good afternoon, good evening, good morning. So SFM, no doubt it is a practical subject, and everybody would be focusing on problematic like portfolio management, derivatives, forex, and general tendencies. They will ignore theory. Okay, if you have gone through the past papers, the last question will always be theory, and they're asking 3 sub questions in theory. So one question from securitization theory question, and one from international financial environment, nothing but it is also called as international financial management in our BCCA textbook. Okay, and the third one, digital finance. So you will get one descriptive theory question, and the weightage of that question is 14 marks. And apart from this 14 marks, you will get 2 multiple choice questions from these from these 3 topics, actually 2 only, securitization and digital finance. From securitization and digital finance, you will be getting 2 multiple choice questions. Okay, this was the trend. So the overall weightage of these 3 chapters is 14 marks theory plus 4 marks MCQs. The overall weightage is 18 marks. Okay, for suppose let us assume if a practical question is tough, practical questions are tough. Okay, sure you are going to get at least 3 14 marks questions from Super 50, but let us assume paper is tough, then you can attempt one theory question. By attempting 14 marks theory question, you can score at least 10 marks, at least 10. In MCQs, you will be getting 20 marks. And how many marks you require to clear SFM? Another 10 marks. Even if you solve one practical question, out of 7 questions, if you can solve 2 questions, you can easily score 40 marks. Okay. So this time, the most important, in my perception, the most important in SFM is these theory topics, 3 topics. These 3 topics are very important because in 3 hours we can complete these 3 topics, and by spending 3 hours of a time you can score 18 marks. Okay, clear? Utmost important. So securitization, digital finance, and international financial management, and these topics are not related to any other problematic chapters like forex, derivatives, portfolio management. Even if you do not have a sound knowledge in these topics, you can go through these theory topics. Okay, clear? So let us start with securitization. In securitization, we have only 7 concepts, only 7 questions, only 7. So definition and concept of a securitization, mechanism of securitization, benefits of a securitization, participants in securitization, problems of a securitization, securitization instruments, and types of securities. Actually, that is not a types of securitization, that is types of securities. So total 7. In December 24, they have asked problems of a securitization, and in June 24, types of a securities, concept number 7, and in the previous attempt, participants in securitization. Actually, the question is primary participants, and here the drawback is till now I used to teach CA final text, but valuation is being done as per CMA final text. Okay, so that's why I have come with a updated version. So this text is as per CMA final study material. The concept is same. Earlier concept was same. Now also concept will remain same, but the text is being changed. Okay, one thing. And one more point is here in one attempt they have asked primary participants, but whereas the answer given in suggested answers is not actually correct, okay, because primary participants are different from secondary participants, but the answer given is participants of a securitization, but the question is more specific, primary participants. Okay, so we have to ignore everything, we should go as per CMA final study material, so do not think deep. Okay, so let us start securitization without wasting time. Okay, shall we? Introduction to securitization. Let me explain with a small example the entire securitization concept. Okay, have you ever gone to the bank? Let us assume HDFC Bank. HDFC Bank will be giving loans, yes or no? So there will be variety of loans. For example, personal loan, gold loan, house loan. So there will be several types of loans. So let us assume HDFC has given a loan to the customer. This function is called as the origination function, and bank is called as the originator. Bank is called as a originator. Customer is called as a borrower. So what the customer will do? Customer will pay equated monthly installment. Yes or no? Customer will prepay the loan in the form of equated monthly installment. Now the question is, tell me whether the housing loan given to the customer is a liquid asset or a illiquid asset. It is an illiquid asset. It is an illiquid asset. Why? The loan given to the customer will be recovered in next 20 years or 30 years. It will take a long period. So that is an illiquid asset. Securitization is simple. Conversion of illiquid assets into liquid assets. Let us see how these illiquid assets are converted into liquid assets. So HDFC Bank has given a loan to the customer. Okay, India's top housing finance company give home loans to the individual borrowers. So these are called as retail mortgages. Retail mortgages. Okay. And next, now what this HDFC Bank will do is HDFC Bank will pool these home loans. Let us assume 100 crore rupees worth home loans were pooled together. For example, loan given to X, Y, Z, all these loans were pooled together and transferred to a special purpose vehicle. All these loan assets, loan is an asset to the HDFC Bank. So these assets are transferred to a special purpose vehicle. Special purpose vehicle means that can be a firm, private limited company or a trust, which is incorporated for a specific purpose. Here the purpose is securitization. Purpose is what? Securitization. Okay. So special purpose vehicle is created and all the loan assets are transferred to the special purpose vehicle. So let us assume the special purpose vehicle is HDFC Securitization Trust. The name itself indicates HDFC Securitization Trust. The trust is created for the purpose of securitization. Are you getting my point? HDFC Bank is transferring all the assets to HDFC Securitization Trust. Not all the assets actually. Only 100 crores worth housing loans are being transferred to the SPV. Clearer? Now, this SPV, what this SPV will do is, SPV will issue securities. And these securities can be called as ABS, asset backed security, or mortgage backed security, MBS. What is this asset backed security and mortgage backed security? For suppose if a securities are backed by a housing loan, that is called as mortgage backed security. For suppose if a security is backed by personal loan, credit card, or non-housing loans, then these are called as asset backed security. Are you getting my point? For credit card, there won't be any collateral security. There won't be any concept of mortgage. Okay. So if housing loan is the backup, then it is called as mortgage backed security. If a non-housing loan is the security, then it is called as asset backed security. So now the securities are being issued by HDFC Securitization Trust. Clearer? And these securities, this asset backed security or mortgage backed security, can be issued in the form of pass through certificate or pay through certificate. Pass through certificate or pay through certificate. Pass through certificate means simple. Whatever the equated monthly installment paid by the borrower, collected by the bank, and bank will pass on this EMI to the SPV, and SPV will pass on this equated monthly installment to the investor. That means the person who is purchasing the pass through security. Pass through security or certificate. Okay. Pay through certificate is different. Pay through certificate. I will explain later. Okay. Pay through certificate. So here we have a concept of trench. What is this trench? Okay. Are you able to understand the concept of securitization? HDFC Bank giving loan to the customer. So HDFC need money. What the HDFC Bank is doing? HDFC Bank will transfer 100 crore rupees worth of housing loans to SPV. SPV will issue securities to the investors. Now the SPV will collect money from investors and SPV will transfer this money to HDFC Bank. And HDFC Bank again will start giving loans. Clearer? Okay. So the types of securities can be what? That can be asset backed security or mortgage backed security, and mortgage backed security can be pass through certificate or pay through certificate. And we have a concept of trench. What is this trench? Who will make investment in securities? Who will purchase the security? So for example, banks may purchase, other banks may purchase securities issued by HDFC Securitization Trust, or provident funds, pension funds, insurance companies may purchase what? Securities issued by HDFC Securities Trust, Securitization Trust, or mutual funds, non-banking financial companies like Bajaj Finance, Muthoot Finance, Manappuram Finance, these may purchase the securities issued by HDFC Securitization Trust. Are you getting my point? Are you able to understand the concept? Now, HDFC Securitization Trust example, it will issue pass through certificate to mutual fund. Mutual fund will pay money to HDFC Securitization Trust. This HDFC Securitization Trust is special purpose vehicle. It will give that money to HDFC Bank, and HDFC Bank use that money for giving loans. Again giving loans. Okay. So this is nothing but conversion of illiquid assets into liquid assets. Clearer? When borrower pays the equated monthly installment, this equated monthly installment is collected by HDFC Bank, will transfer to SPV, and SPV will pay this equated monthly installment to mutual funds. This is what happens. Clearer? So what is the concept of this trenching? Okay, what is this trench? Based on the risk, the securities are grouped into one category. So for example, securities can be divided into three trenches. So first trench, senior A, second mezzanine B, and equity C. What is this trench actually? For example, pension funds. You know the pension. So who will expect the pension? An employee who gets retired, yes or no? They don't want to take risk, yes or no? So they will be interested to take a low risk. So let us assume we issue a securities worth 100 crores. In that 100 crores, 80 crores worth of securities are senior A, 15 crores mezzanine B, and 5 crores equity C. What is this actually? For example, customers may make a default. Customers may make a default. Out of 100 customers, only 99 customers paid money. Then what we do is, first priority will be given to senior A. Second priority will be given to mezzanine B. And third priority will be given to equity C. Nothing but equity C will have a high risk. These are the high risk securities. Generally, these high risk securities are kept by HDFC Bank itself. Nothing but originator himself will be purchasing those securities because nobody will be willing to take. And this can be categorized as credit enhancement. If you're taking a high risk securities, then other security holders will feel safe, yes or no? Because ultimate risk is being taken by what? HDFC Bank. Am I clear? So, equity C. What is this equity C? Generally, these securities are kept by HDFC Bank itself. What is the order of payment? Senior A, mezzanine B, and then equity C. Generally, I have told that there are two types of securities actually, pass-through security, pay-through certificate. In pass-through certificate, what happens is there won't be any kind of a trenches. There will be only one type of a security, and all whatever the EMI paid by the borrower will be passed on to what? Investor, passed on to investor. That is pass-through certificate. In pay-through certificate, what happens is, for example, we give a commitment to senior A category. Okay. So we say that entire amount will be given to you, principal plus interest. But for mezzanine, only interest will be paid. And for equity, no amount is paid. Only on the maturity, the amount will be paid. So that is called as what? Pay-through certificate. They will have a multiple maturity periods. Multiple maturity period. Securities will have a multiple maturity period. That means for few securities we pay at once. We pass on everything. For the other kind of security, we pay only interest. Okay? Clear? Are you getting my point? Trenches. Next, credit enhancement. We have a concept of credit enhancement. Credit enhancement can be internal or external. We should build a confidence in investor. Further, we do a credit enhancement. What is this credit enhancement? Internal means we give a over collateralization. What is this over collateralization? Simple. So what I have told is 100 crore worth home loans are transferred to the SPV. Credit enhancement means instead of transferring 100 crores worth securities, home loans, we transfer 110 crores worth home loans. Securities worth is 100 crores, right? Securities worth is 100 crores. Investors will give 100 crores to SPV and SPV will give this 100 crores to HDFC. What HDFC is giving in return? HDFC is transferring the home loan pool to SPV. So credit enhancements means what? Credit enhancement means 110 crore worth housing loans will be transferred to the SPV. Are you getting my point? Actually, HDFC is taking only 100 crores, but it will be giving 110 crore worth of home loan. This is called as what? credit enhancement or 105 crores. So assets worth 105 crores will be transferred against 100 crores securities. This is over collateralization. Due to this, credit will get enhanced. Are you getting my point? Security holders will feel safe. Next, excess spread. Nothing but interest received will be greater than interest paid. For example, we are taking 12% interest from the borrower. Okay, but we pay only 10%. We commit only for 10%. Even if some customers will make default, still we would be able to pay what? 10%. So this is what internal credit enhancement. So there can be external credit enhancement. What is this external credit enhancement? For example, guarantee may be given by the other asset reconstruction company. For the securities being issued by HDFC Securitization Trust, the guarantee will be given by other company. That means if customers make default, the other company will pay the amount or may take an insurance. If a customer makes a default, insurance company will pay. Insurance company will pay. So this is external. And next, capital. For low rated tranches, what we do is, if you are worried about the repayment, so we are ready to bring more capital. We are ready to infuse more capital. This is called as what? External credit enhancement. Okay. And I have told you the tranches. Tranches can be of three types: A, B, C. A is called as what? Senior A. B is called as mezzanine. C is called as equity. Rating will be given. Obviously, AAA rating will be given to seniors because low risk. Mezzanine B, A rating, and equity C, unrated. So who will give this rating? Credit rating agencies like CRISIL, Credit Rating Information Services of India Limited, or ICRA, Investment Information and Credit Rating Agency. So assess the risk of each tranche. Assess the risk of each tranche. So generally senior tranche will have a low risk because first priority will be given for senior tranche for repayment. So mezzanine rated A. Next we have a concept of arranger. Arranger means what? Arranger can be an Axis Capital or ICICI Security, for example. What this arranger will do? Arranger normally he will be an investment banker. What the investment bank will do? Structure the deal. So the entire process will be structured by the entire deal is structured by the investment bank. Nothing but it will talk to HDFC Bank. It will take the responsibility of creating SPV. It will take the responsibility of getting credit rating to the securities, forming the tranches, issuing securities. Everything is done by the arranger. Okay. It will find investors and it will manage the documentation. Clear? And who will be investing? Generally in case of senior tranche, SBI Life, ICICI Prudential, Employee Provident Fund. Because these insurance companies, they have to make in secured investments. They have to make a secured investment. Mezzanine, NBFC, mutual fund, equity tranche, HDFC itself will retain this to show confidence. Okay, you need not worry. I will be taking at the end. After paying everything, I will take. So high risk will be taken by HDFC itself. Next, cash flow. Are you able to understand the concept? See the cash flow. Homeowners will pay EMI and this EMI will be given to the SPV. SPV will distribute fund in the order. First, senior investors will be paid and then mezzanine and then equity if anything is remaining. Otherwise, they will not get anything. Okay. So what about the initial? Initially, SPV will collect money from SBI Life, ICICI Prudential, EPFO, NBFC, mutual funds, and this amount will be transferred to what? HDFC. Clear? Next, collateralized debt obligation and preferred stock. This I will be discussing in the PDF itself, theory. Let us summarize. Who is the originator in our example? HDFC Bank. So what is the collateral? What is the security is giving? Home loans. Home loans worth 100 crores. If you are giving 100 crores, there won't be any credit enhancement. Generally, we give 105 crores. 105 crores. Again, is the 100 crores worth of securities. So who is the SPV in our example? HDFC Securitization Trust. So what are the securities issued? Pass-through certificate or pay-through certificate. Trenches A 80 crores, B 15 crores, unrated 5 crores. Credit enhancer. Credit enhancement can be internal or external. So guarantee can be given by the Northern ARC Capital. That means if customer makes a default, who will make a payment? ARC Capital will make a payment. Who is the arranger in our example? Axis Capital or ICICI Security. Okay. And next, credit raters. Who is giving a credit rating? CRISIL, ICRA. Investment flow order. Investor flow order. First payment is made to A, seniors, and then mezzanine, B, and then C, equity. Additional layer, so collateralized debt obligation I will explain, and preferred stock. We have a concept of preferred stock. Okay? Clear? Are you able to understand the concept? Now I am going to the theory. Okay? So theory I will not take much time. Definition and concept of a securitization. Securitization general implication is converting a business relation into a transaction. To be specific, it refers to the sale of assets which generate cash flows. That is what happening, yes or no? HDFC is selling asset. What is the asset? Home loan which generate cash flow from the institution that owns them. That is HDFC to another company, HDFC Securitization Trust, termed as SPV, that has been specifically set up for the purpose and issuing of notes. Notes means securities, and the issuing of securities by this second company, that is SPV, will be issuing the securities. Clear? Done. And here assets need not be housing loan, personal loan, or bank loans, whatever. Need not be a loan asset. Asset can be any kind of asset which generate a cash flow. For example, Domino's Pizza has gone for a securitization. Domino's is not a bank, but still it has gone for a securitization. What it has sold actually? It has sold franchise agreements. Franchise agreement, yes, franchise is also an asset. Why? So Domino's, if it give a franchise to the third party, it will get royalty. It will get future income. That income will be transferred to what? Investor. Clear? So here asset need not be a loan actually, but generally securitization is done by the banks only in majority of the cases. In securitization, the loan assets are packaged together, but it need not be a loan asset. Okay, loan assets are packaged together, and their interest payments are used to. We show these interest payments to the investor. If you are purchasing the security, you will get interest income. Okay, so loan assets are packaged together, and their interest payments are used to service the new bond issues. Bonds securitization. Bonds, that is securities. Bond is also known as security. Bonds securitizing mortgages are usually treated as separate class termed mortgage-backed security. Mortgage-backed securities means securities which are issued against housing loans. Clearer? Because how the housing loan is given by the bank? Bank will take a mortgage of a home belonging to the customer. Yes or no? If home loans are transferred to the SPV and if securities are issued, then these are called as mortgage-backed securities. Generally, investors are interested in mortgage-backed securities. Clear? Generally, mortgage-backed securities will be pass-through certificate because there won't be any risk. Customers will be paying on time. because they are mortgage backed. So that's why pass-through certificates are issued. There won't be any concept of trenches. There won't be any concept of trenches. And next, those with other underlying asset. Those with other underlying asset means what? Example, credit card, personal loans. Okay, so these are called as asset-backed securities. In this case, generally pay-through certificates are issued. Clear? Mechanism of securitization, the steps. So this question was not asked. They might ask you this question, mechanism of securitization. The originator selects the receivables to be assigned. In our example, home loans. So the originator means HDFC Bank selects the receivables to be assigned. A special purpose entity is formed. What is the special purpose entity? HDFC Securitization Trust. The special purpose company acquires the receivables, home loans. The special purpose vehicle issue securities which are publicly offered or privately placed. I hope you know the difference between public offer and private placement. The securities offered by the SPV are structured usually A, B, C. Senior, mezzanine, junior. The servicer for the transaction is appointed. The servicer. Generally, originator will be the servicer. I mean, HDFC Bank itself will be the servicer. But the responsibility is to collect EMI from customer and paying it to the SPV. Servicer collects the receivables usually in an escrow mechanism and pay off the collection to the SPV. SPV passes the collection to the investors, This happens in pass-through certificate or reinvest the same to pay off the investors at stated intervals. This happens in pay-through certificate. In pay-through certificate, SPV is having a right to make a reinvestment. Securities will have a multiple maturity periods. The pay down to investors will follow the formula fixed in the transaction, which may either sequentially pay Class A, B and C, or pay them proportionately or in any other pattern. So that will be as per the agreement. Clear? In case of default, the servicer, that is bank, will take an action against the debtors, that is borrower, as the SPV agent. If a customer makes a default, then bank will take an action. If losses are realized, they are distributed in the reverse order of seniority. If losses are realized, then what? First payment will be made to reverse order of seniority. That means junior will be paid. Then, yes. Why? Because ultimately the loss is being borne by the equity. So that's why. Clearer? Next, the benefits of a securitization. From the point of view of a originator. Originator means what? Bank. Bank can use securitization to support rapid asset growth. Why? HDFC Bank is immediately getting 100 crores. And it can use 100 crores for giving further loans. So that will increase the asset growth, yes or no? Next, diversify their funding mix and reduce cost of funding. The credit rating, the liquidity position of a bank will increase. If liquidity position of a bank increases, then the cost of funding will reduce. Reduce maturity mismatches. Next, balance sheet capital management. Bank uses securitization to improve balance sheet capital management. So securitization provides regulatory capital relief in some case, depending on the form of transaction, economic capital relief, and diversified source of funding. Risk management and credit risk transfer. Once assets have been securitized, the credit risk exposure on these assets for the originating bank is reduced considerably. This is because assets have been sold to SPV. Securitization can also be used to remove non-performing assets from the bank's balance sheet. So generally, non-performing assets are sold to the SPV. If a bank balance sheet remove the non-performing asset, then what happen? This will remove credit risk as well as potentially negative sentiment from the balance sheet, apart from being freeing up regulatory capital as a before. Clearer? If there is no NPA in balance sheet, obviously that will be a positive sentiment, yes or no? Clearer? So generally non-performing. For example, if a customer has failed to pay EMI continuously for 4 or 5 months, generally these types of loans will be transferred to the SPV. Clearer? And next, these are the benefits from the point of view of a originator. Do write this text only. Do not write the text as per CA final study material. They are not giving marks. Okay. From the view point of an investor, the potential attraction includes, from the investor point of view, ability to diversify into sectors of exposure that may not be available in regular bond markets. For example, in regular bond markets, what happens is they cannot purchase the house directly. So nothing but what here the investment will get diversified. For example, residential mortgages. What is this residential mortgages? House is mortgaged to the bank. So in regular bond markets, if you are making investment, that investment will be used for some other purpose like manufacturing, something like that. But they will not be making investment in housing sector. Okay, by purchasing the securities of a SPV, so we can diversify. Investors can diversify into sectors of exposure that may not be available in the regular bond markets. Next, access to different risk reward profiles. They will have access to different risk reward profiles because every customer will not have a same risk. Okay, first of all, the risk is getting diversified. Not every customer will make a default, yes or no. So they will have access to different risk reward profiles. So these are the benefits of a securitization from the point of view of what? Investors. Okay, clear? Done. Next, participants in securitization. But in December 2023, the question was primary participants. So primary participants are only 3. Who are the primary participants in securitization? Originator, SPV and investor. Originator, SPV, investor, these are the primary participants actually. But whereas in CMA final study material, so there is no 2 categories, primary and secondary participants. There is only one category, participation. If they ask you to write primary participant, you mention everyone. Originator, HDFC Bank, arranger, Axis Capital, yes or no? Who structures the deal? SPV, special purpose vehicle. In our example, HDFC Securitization Trust. Investors, mutual funds, high net worth individuals, provident fund, pension fund, etc. Next, the servicer. Generally, originator himself will be a servicer. He will collect the EMI from customer and will pay it to the SPV. Rating agencies. Rating agency is generally a secondary participant, not a primary participant. Rating agencies rate the security. For example, AAA rating is given to senior. Mezzanine is given A rating. Yes or no? Enhancement providers. Enhancement can be internal or external. Internal or what? External. Credit enhancement is used to improve the liquidity, marketability and appeal and safety for the underlying cash flows of a new instrument in the capital market. I have told you the example. External credit enhancement guarantee is given by Northern ARC. Clearer? Regulators. They issue various regulations that guides and regulates the securitization process. Next, problems of a securitization. December 2024 question, problems of a securitization. The problems given in CA final study material and CMA final are different actually. Both are correct, but they are different. So value is going as per CMA final study material. So that's why you write this text only. So first one, there are few limitations in securitization. Of course, there are benefits, but there are few limitations also. So securitization has proved to be a costly source. Yes or no? Is it a costly source or not? Because an investment bank arranger like Access Capital, they have to bring together SGFC Limited and they have to create a SPV. They have to take care of a documentation. It includes what it has proved to be a costly source. So that's why, and at the same time, investors will demand a higher premium and additional cost of rating and legal fees. Too much of a cost is involved. Too much of a cost is involved. Setting up of SPV will also require high initial payment. High initial payment. Are you able to see the example? There are a lot of parties involved in what? Securitization process. You have to pay money to the arranger, servicer, credit enhancer. You have to set up a SPV. So it requires initially high payment. So therefore, unless you are going for a huge amount, this may not be cost effective. This may not be what? Cost effective. Okay. Securitization requires high level of a disclosure of a information. Too much of information you have to disclose. To whom you have to disclose the information? You have to disclose the information to the regulator. Not only the regulator, to trustees. Trustees are appointed to safeguard the interest of the investor. So in this CMFL study material, we haven't talked about trustees. You have to disclose information to trustee, rating agencies, and in some circumstances to even to the investors. And investors are generally interested in asset-backed security which have a high quality. Okay, so banks can securitize only the better quality receivables. No investor is interested in what? Low quality assets. Yes or no? Clear? Bank wanted to clear NPVs from the balance sheet. But generally investors are interested in what? High quality loans. That's the drawback. And next what? Banks often allow debt restructuring. What is this debt restructuring? For example, bank has given a business loan to the customer. If a customer is having a cash crunch, if he couldn't pay EMI on time, what the bank will do is bank will restructure. Restructure means bank will allow 6 months more time, or bank may waive off the interest. Bank may waive off the interest. Yes or no? So this restructuring will be allowed. Generally it is allowed by the bank. But since the securitization transactions are looked after by the professional trustees who do not have any discretion, they cannot exercise the discretion, they cannot skip payments, they cannot allow time. So debt restructuring cannot be possible because a trustee has to take care of the investor money. He has to safeguard the investor's money. So that's why this trustee will not have any discretion to allow time or a skip payment. Okay. As per the current accounting standards, securitization accounting leads to upfront booking of a profits. Even though these profits represent not only the profits encashed while making the sale, but even estimated profits based on future profitability of the transaction. What is happening is, as per the current accounting standards, what we are doing is we are accounting upfront booking. We are booking the profits which are not yet realized. Even estimated profits are taken into account. This is also the drawback. Clear? Next, securitization instruments. I have already told asset-backed security, mortgage-backed security. Asset-backed security means what? Example, backed by income generating assets such as credit card receivable, student loans, auto loans, etc. Home equity loans, but if house is not mortgaged, generally this home equities will not come. Student loan, auto loan, credit card receivables. Mortgage backed securities are variations of asset backed securities that are formed by pooling together mortgages exclusively. Generally, home loans are pooled together and securities are issued. These securities are called as mortgage backed securities. These are attractive as there exists a mortgage as the backup. Clearer? Next, collateralized debt obligation. Collateralized debt obligation means consolidate a group of a fixed income assets such as high yield debt or asset backed securities into pool, which is then divided into various tranches. They can be further divided into collateralized bond obligation, collateralized loan obligation, commercial real estate collateralized debt. Securitization instruments can be of two types: asset backed security, mortgage backed security, collateralized debt obligation. What is this collateral debt obligations? Collateral debt obligation means nothing but simple. Instead of pooling the home loans alone, what it will do is it will pool the other securities, other asset backed securities. Other asset backed securities are pooled together. In addition to that, what they might add, home loans, credit cards, all these assets are pooled together. So these are called as collateralized debt obligations. They can be further divided into what? Collateralized bond obligations. These are primarily backed by corporate bonds. Nothing but bonds issued by the corporate companies. Are you getting my point? Instead of pooling the home loans, we pool corporate bonds. We pool what? Corporate bonds. Bonds issued by the corporate companies. So this is called as collateralized bond obligation. Collateralized loan obligation. These are primarily backed by leveraged bank loans. Collateralized real estate, commercial real estate collateralized debt obligation. These are backed by commercial real estate loans and bonds. So these are the securitization instruments. Okay. This asset backed security or mortgage backed security or collateralized debt obligation, these can be what? These can be asset backed securities, can be pass through certificate, pay through certificate, preferred stock certificate, asset backed commercial paper. Clear? If they ask you to write types of securities, you have to write concept number 7, not concept number 6. Clear? Types of securities. Pass through certificate. Different types of securities are issued by SPV. Are you getting my point? Okay. Home loans are pooled together and securities are being issued. These are called as mortgage backed securities, and this mortgage backed security can be pass through, pay through, preferred stock, asset backed commercial paper, interest only certificate, principal only certificate. Clear? Done? And all credit cards are pooled together and securities are issued. These are called as asset backed securities, and this asset backed security can be pass through, pay through, preferred stock, asset backed commercial paper, interest only certificate, principal only certificate. Clear? Ready my point? Pass through means, in case of pass through certificate, as and when cash and principal and interest is received from the original borrower by the SPV, it is passed on to the holders of a certificate at regular intervals. Pass through has a single maturity structure. Be careful, pass through will have a single maturity structure, and the tenure of these certificates are matched with the life of the securitized assets. For example, if loan maturity is 5 years, Asset maturity will also, security maturity will also be 5 years. If a loan matures in 5 years, security will mature in 5 years. These are called as pass-through certificate. Pay-through certificates will have a multiple maturity structure depending upon the maturity pattern of a underlying asset. So that's why they can issue 2 or more 3 types of securities with different maturity patterns like short term, medium term and long term. They might ask you MCQ. Pay through certificate will have a multiple maturity structure. Preferred stock certificate, they might ask MCQ. Preferred stock certificate general meaning is they will not have any voting rights. They will get fixed rate of a dividend actually. But whereas in CMA final study material, what they have given is these are the certificates issued by subsidiary company. Nothing but in the place of SPV, you will get subsidiary company. These are issued by subsidiary company against the trade debts and consumer receivables of its parent company. Parent company is having some receivables, some trade debts. So against these receivables or trade debts, securities are issued by the subsidiary company. These are called as what? Preferred stock. Okay, in other words, subsidiary company will buy trade debt and receivable of a parent company. Okay, to enjoy liquidity. Clear? Nothing but HDFC transferring home loans to HDFC Securitization Trust. Likewise, holding company will transfer receivables to subsidiary company. Subsidiary company will issue securities. Those securities are called as preferred stock certificate. Next, asset-backed commercial paper. So this type of structure is mostly prevalent in mortgage-backed security. Under this, SPV purchase portfolio of mortgages from different sources, various lending institutions, and they are combined into single group on the basis of interest rate, maturity date, and underlying collaterals. They are then transferred to a trust, which in turn issue mortgage-backed certificate to the investor. So what is this asset-backed commercial paper? Under this, SPV purchases portfolio of mortgages from the different sources, various lending institutions. Are you getting my point? Various lending institutions, not from one lending institution. What this SPV will do is SPV purchases different loans from different lending institutions and they are combined into single group on the basis of interest rate, maturity date and underlying collaterals. Then these are transferred to the trust, in turn issue mortgage-backed certificate to the investor. Interest only certificate. Interest only certificate means nothing but payments are made to investors only from the interest income. The name itself indicates the person who is purchasing interest only certificate will get only interest. Principal only certificate means investor will get only principal. Only what? Principal. That's it. With this we have completed what? Securitization. In securitization you will get theory question 4 marks and you might get 1 MCQ. So the weightage of this chapter is 4 to 6 marks. Clear? Are you able to understand the securitization concept? Simple. So the bank will sell loan assets to SPV and SPV will issue securities against these loans. Investor will pay money to SPV and SPV will transfer this money to bank. Clear? Okay. So next, let us see the multiple choice question. The concept of securitization is associated with debt market. Past MCQ. The securitization, who is the issue of a securities? In securitization, who is the issuer of security? SPV. Under securitization process, the bank or a financial institution which gives a loan is known as originator. Obligor means customer. Obligor means customer. Credit enhancer means, in our example, Northern ARC. The concept of securitization is associated with the debt market. Under securitization process, dash are instrument which issued by subsidiary company in respect of receivables of holding or parent company. Preferred stock certificate. Under securitization process, original borrower is known as obligor. Dash certificate under securitization have a multiple maturity structure. Pay through certificate will have a multiple maturity structure. Clear? In pay through securities, so SPV will have a right to reinvest and later on pay off the investors. It will have a multiple maturity structure. So these are the MCQs, okay, given in study material and past MCQ. Only one time the MCQ was asked from this chapter. Clear? Yet another important topic, digital finance. You will get one theory question, 5 marks, plus you may get 1 or 2 MCQs. So the weightage of this chapter is 7 to 9 marks. 7 to 9 marks. Very important topic. And please do not ignore this topic, digital finance. Simple topic. Let us see the overview of this chapter. In digital finance, first we are going to discuss the meaning and the benefits of digital finance. And next, digital finance ecosystem. A digital finance ecosystem. So digital finance ecosystem, it includes users and participants. So digital finance ecosystem, there are 4 subparts: digital infrastructure, digital money, digital assets, and digital financial services. In digital assets, we are going to discuss NFT, non-fungible token, cryptocurrency, stable coins. And in digital financial services, we are going to discuss about payment system and fintech companies. Payment system, okay, and fintech advantages and major developments. In major developments, we are going to discuss payment system and fintech. Be careful. Advantages of digital financial services are different from benefits of a digital finance. Okay, in the past they have asked the question. So advantages of a digital financial services. Okay, and simply this chapter can be divided into 3 parts: meaning, digital finance ecosystem, regulation and governance. In digital finance ecosystem, we have 4 parts: digital infrastructure, digital money, digital assets, and digital financial services. In digital infrastructure, they might ask you to write short notes on a digital infrastructure. In digital infrastructure, we have internet, mobile telecom, data centers, enterprise portals, cloud service, that is not a closed service, that is a cloud service, operational security, application program interface. Okay, so this is the overview. Are you able to understand the overview? Simple. What? 3 parts: meaning, digital finance ecosystem, regulation and governance. In digital finance ecosystem, we have 4 parts. What are the 4 parts? Digital infrastructure, digital money, digital assets, digital financial services. Digital assets. So we have a concept of digital assets. What? Cryptocurrency, stable coin, and we are going to discuss about non-fungible token. So they might ask you to write short notes on non-fungible token, cryptocurrency, or a stable coin. They might ask you MCQ from stable coin or a cryptocurrency. Okay, and they might ask you to write a short notes on neobank. So the latest question is they asked you to write a short notes on neobank. It comes under digital financial services. Digital financial services. Okay, shall we start this topic, digital finance? First, what is this digital finance? Simple. Digital finance is nothing but delivery of a traditional financial services digitally through the devices such as computer, tablet, and smartphones. In other words, digital finance is the term used to describe the impact of new technologies on the financial services industry. So what are the financial services? Example, transfer of money from one person to another person is a financial service. Okay. And next, in-app payment. In-app payment. That but payment making through an app. For example, if you are ordering any food through a Zomato, you make a payment through an app. So that is called as in-app payment. So that is a financial service. Digital finance means a delivery of a traditional financial services. Earlier we used to go for bank for transfer of money from one person to another person. Now those traditional financial services are being delivered digitally. Okay, we are paying electricity bill digitally. We are recharging the mobile. I mean, using online. Or we are recharging the number. So using digital services. I mean, digitally only. So digital finance means simple delivery of a digital financial services digitally through the devices such as computer, tablet, and smartphones. So PhonePe is an example. PhonePe is a fintech company which is providing digital financial services. So differences between the traditional finance and digital finance. Earlier the banking was done at branches. Now online banking, mobile banking apps, and tele-banking. Tele-banking means over the phone. By making a call, you can go for banking. Payment in physical mode. Now we are making a payment in cashless digital modes such as net banking, credit or debit cards, wallets, UPI. You might have registered for CMA final. How you registered for CMA final? Online. Earlier you used to go to bank, take a DD demand draft, and then deposit this demand draft with the chapter office or post. Yes or no? Now you are making an online payment. So this is an example for digital finance. Investment in real or financial assets earlier. Now the investment is being made in digital assets like cryptocurrencies. Earlier investment used to be made in real estate businesses or financial assets like shares, debentures, bonds, etc. Now the investment is being made in digital assets like cryptocurrency, non-fungible token, stable coins, etc. Next, availing insurance and other services through branches. But if you want any insurance policy, you can avail this service through app. Okay, you can download Policy Bazaar app application and you can avail this service. Okay, customer journey. Earlier, customer used to travel to the branch, meet the representative, and that representative will go for lunch. And after lunch, okay, so we wait to receive a decision, travel back to branch, receive funds. Now, apply via mobile phone, get approved, and receive funds instantly. So many of the students might have borrowed money from Slice app, Slice application. So you will make an application, okay, get approved and instantly receive money. So that is a digital finance. Clear? So digital finance benefits. Benefits of a digital finance. I'm not talking about digital financial services. I'm talking about benefits of a digital finance. So what are the benefits of digital finance? It promises to boost gross domestic product. Gross domestic product. Gross domestic product means value for goods and services produced during the year in a country. So due to these digital finance, the GDP of an Indian GDP of India has got increased or not? Yes. For suppose if there was no digital finance, then what? People will not be using Uber. People will not be using what? Ola, Zomato, Swiggy, Flipkart, Amazon, etc., etc. So the GDP might have got affected. But now, what? Because of digital finance, the GDP, gross domestic product, has got boosted. Okay, and we have a greater economic stability, increased financial intermediation, both for customer and for economy. And innovation in digital finance, it had a long-term positive effect for banking performance. The banking performance has got increased or not? Yes, no doubt. Yes or no? Next, digital finance also benefits the money market regulators like RBI, Reserve Bank of India. Digital finance, they can track the transactions. For example, prevention of a money laundering. So the bank has to report suspicious transactions. If a bank has to report suspicious transactions, so through digital finance, the work has made easy. And digital finance has the potential to provide affordable, convenient, and secure banking services to poor individuals in developing countries. Affordable, convenient, and secure banking services. Affordable or not, as everybody can download PhonePe app and they can avail digital finance services. Yes or no? Okay. And digital finance benefit what? Money market regulators. You might have seen Lucky Bhaskar movie. Yes or no? Due to digital finance, what? Those kind of frauds can be avoided. And next, digital finance can also lead expansion of basic financial services to individuals, since nearly most of the people in the developing world already own a mobile phone. As already owning a mobile phone, so this digital finance will expand the basic financial services to all the individuals. Yes or no? Everywhere we are using what? UPI payment. Yes or no? For small payments also, for 10 rupees, 5 rupees also, we are using UPI payments. So these are the benefits of a digital finance. Okay. What is the next concept? Digital finance ecosystem. Digital finance ecosystem may be defined as users are participants and their complex transactional relationship in the digital environment. Simple terms, a digital finance ecosystem includes what? Users are participants and their complex transactional relationship. So what does it include? So digital finance ecosystem includes what? Digital infrastructure. A digital infrastructure. Okay. And next what? Digital money. Digital money. Central bank digital currency. And next what? Digital assets like NFT, non-fungible token, cryptocurrency, stable coin. Okay. And next what? Digital financial services. So digital finance ecosystem includes what? Four things. What are the four things? Digital infrastructure, digital money, digital assets, digital financial services. Clearer? And one more topic I have forgot to mention. So digital cube. So digital finance landscape. So actually I have forgot to mention in the chart. Digital finance landscape, it has a three dimensions. It has a three dimensions. Okay. So I forgot to mention. So actually there are four concepts: meaning, digital finance ecosystem, and next what? Digital introduction, digital finance ecosystem, and next what? Digital finance landscape. Digital finance landscape, it has a three dimensions. It has a three dimensions. Okay. So let us discuss about digital finance ecosystem. Digital finance ecosystem includes what? Digital infrastructure, digital money, and next digital assets, and next one what? Digital financial services. Clear? Digital infrastructure. So digital finance ecosystem includes what? Includes digital infrastructure. What is this digital infrastructure? Digital infrastructure refers to digital technologies that bring together and interconnect physical and virtual technologies. Nothing but to deliver financial services digitally, we require digital infrastructure. So first and foremost component of a digital infrastructure is internet. Without internet, so traditional financial services cannot be delivered digitally. Yes or no? This is the prime enabler or a connecting force that integrates the digital world, including Digital finance. Second, what else we require? Mobile telecom. For example, if you are making any transaction online, you will receive a OTP, one time password, and you require digital communication suite, including application. Digital communication suite, including application. Yes or no? Application examples. For example, you might have downloaded BCCA app to get this PDF. Yes or no? So we are providing services digitally through an app, BCCA app. Yes or no? So application. These components connect various organizations to a common network and enables communication for digital transactions. Okay. So digital communication suite example Instagram, Gmail. These are the examples for digital communication suite. Okay. So without these we cannot avail digital financial services. Yes or no? If you are making an application, you will get confirmation mail. Yes or no? You have to give consent through a mail. So these are the digital communication suites. Application means what? App. And next what? Data center and network. For example, we are recording this class. Okay. So this class has to be stored somewhere. Yes or no? For suppose we are uploading this class in our BCCA app. Okay. We are paying commission to the person who is providing the application services. Class Plus is providing these services, or Tech Hand is providing these services. So what we do is we pay commission to the Tech Hand. Why we are paying commission to the Tech Hand? Because Tech Hand has to store this data, store this class at data center. Okay. So data center is a physical facility that organizers organizations use to run their critical application and data. So data center is a physical facility, just like a godown. So we have a data center which will store the data. Clear? And next, enterprise portal, platform, system and software. For example, Coca-Cola company has implemented an intranet, so to integrate the workforce throughout the world. So that is enterprise portal, platform, system and software. It is also known as enterprise information portal. It is a framework for integrating information, people and process across organizational boundaries in a manner similar to the more general web portal. Like internet, we have a concept of intranet. Intranet is an example for enterprise information portal. Next, cloud services. Cloud services means a wide range of services delivered on demand to companies and customers over the internet. Cloud services. So these cloud services can be of three types. Cloud services can be of three types. First one, infrastructure as a service. Infrastructure as a service. This will provide a virtual computing resources over the internet. Storage facility will be provided. Storage facility will be provided. For example, Amazon Web Services. Amazon Web Services is an example. Likewise, Google Computer Engine, Microsoft Azure. All these are examples for what? Infrastructure as a service. Nothing but they will provide a storage facility. Next, a platform as a service. Platform as a service means nothing but they will not provide storage facility, but they will provide a platform to the customer. Okay, and customer can develop, run and manage application. Are you getting my point? Platform will be provided to develop, run and manage application. Simple example. For example, Class Plus. Class Plus will be taking a infrastructure as a service. Class Plus will be taking a cloud service. What type of a service it will take? It will take a infrastructure as a service. What about the BCCA? BCCA will be taking a platform as a service. BCCA is using Class Plus platform for what? To develop, run and manage application. That's it. without dealing with the infrastructure. We are not purchasing the storage facility. Okay, we are just paying commission to the class plus or a tech hand. Clear? Am I clear? Next is software as a service. Delivers a software application over the internet. For example, Netflix. Okay, application over the internet on a subscription basis. So Google Workspace, Gmail. So Gmail is what? It is providing a software applications over the internet on a subscription basis. Clear? So these are the cloud services. And next what? Operational security, user identity and data encryption. So simple. If you're logging in Netflix, they ask for identity, yes or no? Login ID, password. And at a time, two people cannot watch a series, web series or a movie in a Netflix. So nothing but what? There is an operational security. Operational security is a security and risk management process that prevents sensitive information from getting into wrong hands. So for example, if you are purchasing any class in BCCA, only one login is allowed, yes or no? So only you can log in through your number. So likewise, next API and integration. API means application programming interface. It is a messenger that processes request and ensures seamless functioning of an enterprise system. The application programming interface is the connection between two or more applications. Two or more applications means nothing but, for example, if you're purchasing a class in BCCA app, you will be making payment through Razor Pay. Yes or no? Nothing but two applications are being integrated. What are the two applications? BCCA and Razor Pay. Likewise, if you are making a payment in Zomato or a Swiggy, okay, so Zomato and PhonePe are integrated, or Zomato and UPI payment are integrated, Zomato and net banking. So various applications are integrated. Okay, so this is called as application programming interface. So digital infrastructure includes what? Components of digital infrastructure includes what? Internet, mobile telecom, data communication suites including applications, data center and network, enterprise portal, platform system and software, cloud services. Cloud services means delivery of services over the internet. Cloud services can be what? Infrastructure as a service, platform as a service, software as a solution. Operational security, user identity and data encryption, application programming interface and integration. Clear? Next concept, digital finance ecosystem includes what? Digital money. Okay, in digital money we are going to discuss CBDC. What is this CBDC? They might ask you to write short notes on CBDC, central bank digital currency. Central bank digital currency is nothing but a digital currency issued by the central bank. What is the central bank in India? Reserve Bank of India. Reserve Bank of India. It is also a cryptocurrency, but this cryptocurrency is issued by what? It is similar to cryptocurrency, digital currency, and issued by central bank. So CBDC are digital tokens similar to cryptocurrency issued by central bank. CBDC is a high security digital instrument like paper bank notes. Okay, we can use the paper bank notes for means of a payment. It is a unit of account. We can say we have 100 rupees, 200 rupees, 500 rupees, yes or no, unit of account. And a store of value. We can store money, yes or no? We can store money. Similar to paper bank notes, CBDC is also a high security digital instrument. It is a means of payment. We can use that currency for means of a payment, for making a payment. It is a unit of account. We can say I have 1,000 rupees, 2,000 rupees, and it is a store of a value. Right now in India, we have a digital rupee, but it is not available for retail purpose throughout India. It was started as a pilot project. So pilot project means what? Nothing but instead of implementing throughout India, generally the government will be taking it as a pilot project, and it will be implemented in only few cities. If it is working out, then it will be implemented throughout the India. So right now CBDC, that means that the digital currency issued by the Reserve Bank of India, is not prevalent throughout the India. Okay. As such, digital fiat currency in the form of CBDC, it is the liability of a central bank just as a physical currency. If you are holding 100 rupees, that 100 rupees is asset to you and liability to the bank. Similarly, if there is a central bank digital currency, it is a liability to the central bank and it is an asset to the person who is holding it. And it is a digital bearer instrument. A digital bearer instrument means nothing but a person who is holding that instrument will be the owner, bearer. A person who is bearing it will be a owner. It can be stored, transferred and transmitted by all kind of a digital payment system and services. So right now in India, CBDC, central bank digital currency, is not prevalent. Okay. So this digital currency is used, right now it is being used only for interbank settlements. Interbank settlements only. The potential advantage. What are the advantages of CBDC? CBDC advantage is technological efficiency in storing and transacting with reduced cost. Obviously, we doesn't require what? Lockers. Okay, in bank, strong room. No strong room is required for storing this CBDC, central bank digital currency. Keeping track of transaction, exact location of a money, we can track the transaction. Yes or no? Preventing illegal activities like money laundering, tax evasion, terror financing, because we can track the transaction, where the money is going. But whereas physical currency we cannot track. Providing a digital record of every transaction will get automatically recorded. More secure payment system. Introducing competition and resilience in the domestic payments market. Promoting financial inclusion. Even a person who is in remote place can avail the services of central bank digital currency. So these are the potential advantages of central bank digital currency. Okay, am I clear? So CBDC advantage is what? Reduced cost of storage. And next what? Keeping the track of a transaction, exact location of money, and we can prevent money laundering, conversion of illegal source of money to legal source, tax evasion, nobody can avoid tax. Next what? Terror financing. Okay, so to carry on the terrorist activity, they need money. Okay, if there is only CBDC, central bank digital currency, we can track the location and we can trace the terrorist also. Clear? Done. And next concept is what? Digital asset. We have completed digital infrastructure, digital money, and next concept is digital asset. In digital assets, we have three types: non-fungible token, cryptocurrency, and stable coin. They might ask you to write short notes on non-fungible token or cryptocurrency or a stable coin. They might ask you MCQ also, multiple choice question also. Okay. Digital asset. Next concept, what? Digital asset. Digital asset means nothing but anything that is stored digitally and uniquely identifiable that the owner can use to realize the value. Digital assets include non-fungible token, private cryptocurrency, stable coin, which are immensely popular in today's digital age. I mean, in India, non-fungible tokens are not they are not popular actually, non-fungible token. But in America, they are little bit popular. Okay. So what are these digital assets? Digital assets means assets which can be stored digitally and is uniquely identifiable, and owner can use it to realize the value. Like any other asset, digital asset can also be transferred. What are the examples for digital assets? Non-fungible token, private cryptocurrency, stable coin. So what is this non-fungible token? So non-fungible token is a cryptographic asset on a blockchain. What is this blockchain? Blockchain is a public ledger. Public ledger, anybody can view this with a unique identification code and metadata that distinguish them from each other. So cryptocurrency is different from non-fungible token. Cryptocurrency examples: Bitcoin, Tether USD. Tether USD actually it is a stable coin. So cryptocurrency examples: Ethereum, okay, Dogecoin, and Bitcoin. These are the examples for cryptocurrency. Cryptocurrency is different actually. Cryptocurrency is different. NFT is different. NFT means a cryptographic asset on a blockchain with a unique identification code. What is this unique identification code? So let me tell an example. National Basketball Association. So we have a website, NBA Top Shot. If you go through that website, one video clip has been sold for $2 lakh. Video clip. Okay. First of all, some people they will be, crazy about the celebrities, yes or no? They will get an autograph. Some public might feel why those people are crazy, why they are taking an autograph, what they will get actually, yes or no? Similarly, some people might purchase a non-fungible token. What is this non-fungible token? So non-fungible token is a cryptographic asset on a blockchain, unique identification code. For example, one video clip was sold for $2 lakh. Sir, one video clip $2 lakh, and that person what he can store it. If he want, he can sell it. He can buy or sell. Okay. Sir, is that video clip will be available or will be visible only to that person? No. That is available on YouTube also. You can watch that video clip. Okay. But the point is, he will be the owner. He will receive a message. You are the owner of this asset. You will be the owner of this asset. Sir, what is the logic behind this? Simple. People are purchasing a painting. Yes or no? The person will be purchasing a painting for $2 lakh or $10 lakh. What is he actually getting? Even if you take the picture of that painting, you will get the same feel. Yes or no? So then why he is purchasing the painting for, that is a luxury item, yes or no? Proudly he can say, I bought a painting for $20 lakh. So likewise, people will be purchasing what? Non-fungible token. So non-fungible token, there are many examples, non-fungible token. For example, the first tweet, just setting up my Twitter. This NFT version was sold for $2.9 million. $2.9 million. Twitter's co-founder, Jack Dorsey, tweeted a link to a tokenized version of the first tweet ever, in which he wrote, just setting up my Twitter. So that first tweet was sold for rupees what? $2.9 million. So what the person who is actually buying that tweet will get? So that is his pleasure, that's it. You're getting my point? So NFT, it is a new revenue model. NFTs are created through a process called asset tokenization. Asset tokenization. Unlike cryptocurrencies which are fungible as each unit of cryptocurrency represent same value and characteristic. Cryptocurrency is different. What is this cryptocurrency? You might own one Bitcoin. I also might own one Bitcoin. And the Bitcoin which I am owning and you are owning, the value will be same. They both are identical. But NFT is unique. Only you will get the ownership on that NFT. So cryptocurrency what? So each unit will have a identical value. So non-fungible, nothing but non-identical. They are unique. Non-fungible tokens are digitally represent any asset, including online only assets like digital artwork. Digital artwork. For example, if I am writing my name, Ravi, so this is a okay. Some person online student might purchase it for rupees what? Okay, 30,000 or 40,000. Why is he purchasing? Depends. Okay, clear. So digital artwork or any real asset such as real estate. NFTs are created through asset tokenization. Asset tokenization is the process by which an issuer creates a digital token on a distributed ledger or a blockchain which represent either digital or physical assets. So NFTs are created through asset tokenization. NFTs are different from cryptocurrency. So cryptocurrency example Bitcoin. So if I am holding one Bitcoin and you are also holding one Bitcoin, the value will be same. But NFT is different, non-fungible token. For example, I'm holding one first tweet. So I bought it for $2.9 million. You bought video clip, NBA video clip. Okay, that basketball, putting a ball in a basket, that video clip. You bought it for $2 lakh. Okay, so yours is unique, mine is unique. And there are NFT bananas. You might have seen banana putting a sticker on it, silver sticker. Okay, sir, one banana and one sticker, they might cost only 2 rupees. Still, that was bought for, okay, that was sold as an NFT, digital art work. Clear? So they might ask you to write a short notes on a NFT, non-fungible token. And there are monkey NFTs. Monkey NFTs. So this is one example for what? NFT. This is an example for NFT. Okay, banana on a wall with a sticker. So crypto investor pays $6 million. How much amount is paid? $6 million for a banana and plans to eat it. Okay, so clear. So NFT. Next, private cryptocurrency. Private cryptocurrency means nothing but the cryptocurrencies which are not issued by the central bank. But to differentiate, we are calling it as a private cryptocurrency. But there is no concept of private cryptocurrency. There is no such concept actually. Because all the cryptocurrencies are traded in a public ledger, public domain. Everybody can access it. Cryptocurrency, sometimes called cryptocurrency or crypto, is any form of a currency that exists digitally or virtually and uses cryptography to secure transaction. It is a peer-to-peer system that can enable anyone, anywhere to send and receive payment. Peer-to-peer means equal. All are equal. Anybody can send and anybody can receive from anywhere. The next, working of a cryptocurrency. Cryptocurrency run on a distributed public ledger called blockchain. This sentence was asked as an MCQ. 2 marks MCQ. Cryptocurrency run on a distributed public ledger. The key points of a cryptocurrencies are they run on a public ledger called blockchain. It records all the transactions. As and when the transaction happens, automatically it will be recorded. A record of all transactions updated and held by currency holders. Generally, the difference between the digital currency, that is cryptocurrency, and physical currency is, in case of physical currency, the currency is regulated by a central bank, RBI. An intermediary is required. Yes or no? For example, if you want to make a payment to the party, the bank is the intermediary and there is a RBI to regulate. But whereas cryptocurrency, no one will be regulating. The main feature of us cryptocurrency is decentralized. They are decentralized. So cryptocurrencies run on a distributed public ledger called blockchain, a record of all transactions updated and held by currency holders. Units of cryptocurrencies are created by a process called data mining, called mining. NFTs are created through a process called asset tokenization. Cryptocurrencies are created through a process called mining, which involves using computer power to solve complicated mathematical problems that generate coins. How these coins are generated, bitcoins, by solving the complicated mathematical problems using the computer power. Users can also buy the currency from brokers, then store and spend them using cryptographic wallets. So, one interesting point is Bitcoin was implemented in the year 2009. It was started in the year 2009, and the first transaction was a person used Bitcoins to purchase two Papa John's pizza. To Papa John's pizza by spending 10,000 bitcoins. 10,000 bitcoins. So let us see what is the bitcoin value as on today. 88 lakh 86,254. Approximately 90 lakhs. 90 lakhs. Okay. So the point is that person has spent what? 10,000 bitcoins for purchasing two Papa John's pizza. Nothing but the two pizzas cost as on today is 10,000 into 90 lakhs. Nothing but approximately 9,000 crores, 8,600 crores. Okay. And that day is called as Pizza Day, Bitcoin Pizza Day, May 22nd. May 22nd is called as a Bitcoin Pizza Day because that person has bought two pizzas just for 10,000 bitcoins. Okay, in the year 2010. Now we are in 2025. Okay. So examples of cryptocurrencies: Bitcoin, Ethereum, Litecoin, Dogecoin. This Dogecoin is a meme coin. Meme coin. You might have seen this Chimtu. Chimtu. Okay, in memes. In memes, you might have seen this dog face, yes or no? So this Dogecoin is created by Billy Marcus and Jackson Palmer to make a fun of this cryptocurrency concept, because everybody are crazy about, they have wanted to purchase Bitcoin. They wanted to make a fun of this cryptocurrency and they have created a meme coin, and that meme coin is called Dogecoin, and even that Dogecoin is having some value, 19.34. Okay. So these are the examples of cryptocurrencies. Advantages. So these advantages are similar to CBDC actually. So cryptocurrencies do not need any centralized intermediary. No bank is required, no monetary institution to enforce trust and transaction between two parties. It ensures easy and faster transfer directly between two parties without the need for a trusted third party. Cryptocurrency investments can generate profits, of course losses also. They can be easily traded on a crypto exchanges and offers high liquidity and diversification. High liquidity, you can sell at any point of a time, and diversification. Disadvantages. Cryptocurrency may facilitate money laundering, hence a popular tool with criminals. Criminals may invest illegal money in cryptocurrencies, yes or no? They can store. Okay, so the government cannot recover the money. And in reality, cryptocurrencies are highly concentrated. Not just the cryptocurrency, everything is highly concentrated. What is this highly concentrated? Nothing but, for example, as per MIT study, found that only 11,000 investors held roughly 45% of Bitcoin's surging value in the world. Around 45% bitcoins were held by 11,000 investors. Even wealth is also highly concentrated, yes or no? Most of the land holdings, stock market, shares, whatever the assets, they are highly concentrated. Highly concentrated means what? Huge wealth is held by small population. So that is called as highly concentrated. So those people can influence the market, yes or no? And next, cryptocurrencies are not environmental friendly. Why the cryptocurrencies are not environmental friendly? Because cryptocurrencies are created through the process called mining. We have to use computer power to solve complicated mathematical problems. So we need huge computer resources. So that's why the cryptocurrencies are not environmental friendly. Cryptocurrencies are traded in public market, suffer from extreme price volatility. Price volatility. I mean, more than a stock. More than a stock actually. Many cryptocurrency exchanges and wallets have been hacked. As this is a digital currency, hackers may hack and sometimes resulting in millions of dollars worth of coins stolen. Recently, cryptocurrency was hacked. Cryptocurrency. Okay. Cryptocurrency platform Coinbase warns of up to $400 million hit from cyber attack. Okay. So Coinbase hacked. Cryptocurrency what? Coinbase, it was hacked. So that is okay. And hackers demand $20 million in Bitcoin, threaten to leak customer data. Coinbase is the cryptocurrency. So they have stolen the cryptocurrencies and they are asking for what? Ransom. What is the ransom? $20 million in Bitcoin. They have stolen Coinbase and they are asking $20 million Bitcoin. Okay. So clear. Next. Are the cryptocurrencies private? Actually, there is no such concept, private cryptocurrency. But to differentiate from the CBDC, central bank digital currency, we are calling the Bitcoin, Ethereum, all these currencies as a private cryptocurrencies. Otherwise, both are same. All are operated on a public ledger, and that concept is called as blockchain technology. Okay, clear? So this is what a private cryptocurrency. They might ask you to write a short notes on private cryptocurrency, and you might get MCQ also, multiple choice question. The next concept is what? Stable coin. A stable coin is a cryptocurrency which is pegged. Pegged means linked. Stable coin are less volatile. Stable coins are less volatile. Less volatile means the value will be less fluctuating. Stable coin value. Why the stable coin value is less fluctuating? Because they are linked to a reserve asset. So in reset and they have asked MCQ on this topic. Stable coin is a cryptocurrency which is linked to any reserve asset like a fiat currency. Fiat currency example dollar. Stable coin example Tether USD. Tether USD. So Tether USD is a stable coin. So this Tether USD value is linked to the value of a dollar. If a dollar value increases, Tether USD value increases. So why these are called as stable coin? Because this stable coin, Tether USD value depends upon the value of fiat currency, and fiat currency value will not be fluctuating frequently. Okay? Or any other commodity. For example, stable coin may be linked to the value of a gold, or value of a silver, or any other cryptocurrency. Any other cryptocurrency. Tether USD, True USD, these are the stable coins. These are linked to the dollar, fiat currency. And stable coin can also be linked to what? Commodity or any other cryptocurrency. It is tokenized version of the asset and can be introduced subtly into a blockchain system to facilitate seamless past transaction, improved arbitrage and exchange of a value. So there are variants of a stable coin. First one, fiat collateralized stable coin. Fiat collateralized stable coin example is True USD, Tether USD. And other three, they are not such popular. There are no examples also. I mean, commodity backed stable coin. Commodity backed stable coin means a stable coin may be linked to gold or a silver. Crypto backed stable coin. Crypto backed stable coin. So crypto backed stable coin, we have a stable coin which is linked with Ethereum. Ethereum is a cryptocurrency. Ethereum is a what? Ethereum is a cryptocurrency. And a currency, a stable coin which is linked to Ethereum is called as what? Crypto backed stable coin. Crypto backed stable coin. So crypto backed stable coin example DAI. It is linked to what? Ethereum. It is linked to Ethereum. DAI. Clear? And algorithm stable coin. Algorithmic stable coin. Limitations of a stable coin. So what are the limitations of a stable coin? Value of a stable coin is based on people's trust in the company holding the collateralized reserve asset, and that the trust may waver on occasion. Stable coins may lose value if the company goes bankrupt. If a company is going bankrupt, then stable coin may lose value. It is critical for the holders to declare solvency to maintain trust in the coin and its value. Unless there is a sense of unrest in a fiat or commodity market, stable coins are not meant for trading gains. What is the last point? Stable coin means a currency which is linked to a fiat currency or a commodity or any other cryptocurrency. Yes or no? So what we are saying is, for example, True USD. True USD is a stable coin. It is linked to fiat currency USD. If USD value increases, then True USD value will also increase. Yes or no? Now, if you want to get a gain, there should be unrest. There should be a unrest in fiat or a commodity market. Then only the stable coins will make a profit. Otherwise, no. I mean, there should be some unrest. Unrest in the sense what? For suppose there is a trade depression. Okay, then what happens? The dollar value might decrease. If a dollar value might decrease, then if you're going for short selling, you might get benefit. If the dollar value increases, fast, then you will get profit. If there is any unrest, if there is any unforeseen circumstances, then only the stable coins will make profit, otherwise no. So this is the disadvantage. They are less volatile. Limitation of a stable coin is they are less volatile. Investor may not make a profit. Clear? Done? And now, so the points what we are going to discuss, these are the simple points. Digital financial services, the third component of digital finance ecosystem, fourth component. The fourth component of digital finance ecosystem is digital financial services. Digital financial services, this already you know. Digital financial services are financial services accessed and delivered through digital channels, including via mobile devices. What are the advantages of digital financial services? So this question they have asked, digital financial services. Digital financial services. Advantages, improved customer experience, of course, Zomato, Swiggy, ease of access, streamlined operations, reduction in cost of a delivery. Okay. Cost of delivery means not food delivery, money delivery. Clear? So these are the advantages of digital financial services. Major developments in digital financial services, payment system. So first the payment system was started with digital wallets. So digital wallets, these are basically a type of prepaid payment instruments. Do you remember Paytm in initial days? First we should transfer money from our bank account to Paytm, and then we use this Paytm balance to do a shopping. Yes or no? So this is basically a type of what, prepaid payment instrument. If you have a money in your wallet, then you can use it. Otherwise, no. So prepaid payment instrument. A prepaid payment instrument refers to such instrument that facilitate purchase of goods and services against the value stored in them. Okay. Next, wallets are closed. Wallets are closed or semi-open, can be used for specific purpose, which are reloadable and accepted by specified service providers or merchants with which the wallet license holder has the contract. Are you getting my point? So you might have seen MobiQuick wallet. So the license holder will have a contract with various websites. So generally these wallets are semi-open or closed. Semi-open means what? We cannot use for all the purposes. We can use only for specified purposes only. So because the payments are accepted by specified service providers only. So right now all service providers are accepting, but in the initial days only the specified service providers they used to accept the payments. So this is digital wallet. Next one is UPI. They might ask you to write the short notes on UPI. UPI full form is Unified Payment Instrument. Digital payment instrument. Okay. UPI full form is what? Unified Payment Interface. Sorry. UPI means Unified Payment Interface. Is a system that powers multiple bank accounts into single mobile application, merging several banking features. Open your PhonePe or UPI. Yes or no? UPI is a mobile application. What is it doing? It is holding the multiple bank accounts. Yes or no? In PhonePe we can link multiple bank accounts, merging several banking features. Instead of going to the bank, what we can do is we can do banking using PhonePe or UPI app. Yes or no? Unique features of UPI. What are the features of UPI? Immediate money transfer through mobile device. Single mobile application for accessing multiple bank accounts. For example, I have an account in ICICI, Bank of Baroda, Union Bank. Okay. But I can use only single mobile application, PhonePe. Next, single click two-factor authentication. Align with the regulatory guidelines. Single click two-factor authentication. Authentication means authorization. We authorize the PhonePe transaction through a password. Yes or no? Two-factor authentication means first we type mobile passcode and then PhonePe password. QR code enabled. Best answer to cash on delivery hassle, running to an ATM or rendering exact payment. Exact amount. Yes or no? Earlier we used to search for change. Now no need to search for change. Rendering exact amount. We need not worry about rendering exact amount because we can do a PhonePe UPI payment. Merchant payment with single application. In-app payment. In-app payment means, for example, Zomato, you're making an in-app payment. Utility bill payments, electricity bills, over-the-counter payments, QR code-based payments, raising complaint from mobile app directly. If there is any wrong payment, you can raise a complaint through mobile app. All these are the features of a UPI. Benefits of UPI. Benefits of UPI to the bank. What is the benefit to the bank? Single click two-factor authentication. Universal application for transaction. Safer, secured and innovative. Enable seamless merchant transaction. These are the benefits to the bank. What are the benefit to the customer? Round the clock availability, single application for accessing different bank accounts, single click authentication, raise a complaint from mobile app directly. And next what? To the merchant. Next what? To the merchants. To the merchants, what are the benefits? Seamless fund collection from customers. We can easily collect fund from the customers. For example, BCCA app. So without involvement of any human, we are able to collect money from students, yes or no, throughout India. And suitable for e-commerce transaction, resolve the cash on delivery collection problem. Cash on delivery collection problem, in-app payment. Students can make a payment through app. So this was asked as an MCQ in first attempt, new syllabus. Which of the following is benefit to the merchant? What is the benefit of UPI to the merchant? In-app payment. Resolve the cash on delivery collection problem. Clear? What are the examples of some popular UPI service providers? Beam, Axis Bank UPI, PhonePe, Paytm, Google Pay, etc. All these are examples. Clear? Next, Neobank, December 24 question. Write a short notes on Neobank. What is this Neobank? Neobank is also known as an online bank, internet only bank, virtual bank, digital bank. Have you heard about Neobank? Neobank, example Jupiter. You might have seen Jupiter, Instant Pay, FI Money, Neo, Mahila Money. All these are examples of a top neobanks in India. So these are online banks, internet only bank, virtual bank, digital bank. So these are contrast to the physical bank, okay? It is a type of a direct bank that operates exclusively online without traditional physical branch networks. You will not find any physical branch network. They use technologies such as artificial intelligence and machine learning to offer personalized and customized financial services to end users and minimize the overall operating cost. Yes or no? No physical place is required. No rentals to be paid. No furniture is required. No AC or power bill need to be paid, because they operate online. So benefits of Neobank. What are the benefits of Neobank? Highly convenient, user-friendly banking services, cost-effective, provide financial management services. Provide financial management services. Nothing but they will provide a statement. So how much money are you spending and on what purpose are you spending? So that statements will help you to manage your finance better. 24/7 customer support, high security features, simple and user-friendly mobile app interface. These are the benefits of what? Neobank. Clear? Top neobanks in India: Jupiter, Instant Pay, FI Money, Neo, Mahila Money, etc. But the point is actually the UPI itself is serving the purpose of what? Neobank also. So generally nowadays we cannot differentiate between wallet, UPI and neobank. So initially Paytm has started as what? Wallet. Later on it was converted into what? UPI, Unified Payment Interface. Getting my point? So PhonePe is almost, it is providing every financial services digitally. Clear? And they are dynamic. Are you getting my point? They are dynamic. Right now under Neobank we might be saying Jupiter as an example, but in next few days what this Jupiter might become UPI. Next, fintech. Fintech means technologically enabled innovation in financial services that could result in new business models, applications, processes, or products with an associated material effect on financial market and institutions and the provision of a financial services. Fintech. What is this fintech? Fintech means a technologically enabled innovation in financial services. So the example for this is, you might have seen Pine Labs when you have gone to the PVR cinemas, swiping machine, Pine Labs. Nowadays, instead of swiping, we are scanning. What is this Pine Labs? Pine Labs is nothing but a fintech company. BillDesk. BillDesk is also a fintech company. So what is fintech? Fintech means technologically enabled innovation in financial services. Types of fintech services: alternative lending, insurtech, payments, wealth tech, reg tech. Okay. So this fintech in India movement was started in 1990s, second half of a 1990s. Pine Labs, a digital payment solution provider, was founded in 1998. BillDesk in 2000. All these are fintech companies. Getting my point? You might have seen Pine Labs in PVR cinemas. So Pine Labs is a fintech company. It was started in the year 1998. BillDesk. You might have seen BillDesk also while doing a registration or something, while paying exam fee. BillDesk is also a fintech company. Okay, fintech means nothing but technologically enabled innovation in financial services. Policy Bazaar, the online insurance aggregator, came in 2008. If you want to take a policy, term policy, life policy, or medical policy, this Policy Bazaar will help you. Thereafter, India saw a huge growth in fintech firms in the next 20 years. As of June 2020, India has around 2174 fintech startups. Bengaluru and Mumbai contribute to the most of these companies. According to Huron Global Unicorn List, India was the home to 21 unicorns with a collective valuation of 73.2 billion. You need not retain these numbers. Why? These numbers keep on changing. These numbers keeps on changing. So fintech firms in India, Paytm. Once again, I am telling, do not get confused. Okay, Paytm is a UPI as well as a fintech firm. Policy Bazaar is a fintech firm. PhonePe is a fintech firm as well as what? UPI. Cred. Initially, it was used for payment of credit card bills. Okay, Bharat Pay, Grow, Digit Insurance, all these are examples for what? Fintech firms. Clear? Next, digital finance landscape. Actually, in the introduction, I have missed this digital finance landscape. So we can call it as digital finance cube. Digital finance cube has a 3 dimensions. Digital finance has a 3 dimensions. What are the 3 dimensions? First one, digital finance business functions. Digital finance business functions. Nothing but digital financial services. We can call them as digital finance services. So digital finance business functions can be digital financing, digital investment, digital money, digital payment, digital insurance, digital financial advice. These are the business functions. So, who will perform these functions? These functions are performed by fintech companies. Fintech companies like Paytm, PhonePe, BharatPe, etc. Or traditional service providers. Traditional service providers. Clear? Digital finance landscape has a 3 dimensions. Digital finance cube has a 3 dimensions. They might ask you an MCQ. Which of the following is not a dimension of a digital finance cube? Okay, and they might ask you an MCQ, which of the following is not a digital asset? Which of the following is not a digital asset? Clear? Okay, and which of the following is not a component of digital finance ecosystem? Digital finance ecosystem. For example, digital liability is not a component of a digital finance ecosystem. Because what are the components of digital finance ecosystem? Digital infrastructure, digital money, digital asset, and digital financial services. Likewise, what are the three dimensions of digital finance cube? Digital finance business function. So who will perform these functions? Digital finance institutions. Digital finance institutions can be fintech companies or traditional service providers like ICICI. They use digital finance technologies. Digital finance institutions will use digital finance technologies to provide digital finance business functions. So there are three dimensions in digital finance cube. What are the digital finance technologies? Blockchain, public ledger, okay, blockchain, social network, near field communication, peer to peer technology, big data analytics enablers. These are the technologies used by the digital finance institutions to provide digital finance business functions. And digital financing includes crowdfunding, lease financing, electronic invoicing, invoicing financing, invoice factoring, invoice financing, and invoice factoring. Okay, if you want at least one sentence, do not take a chance, go through the study material, okay, or else I will provide a revised PDF. Go through it because they might ask you MCQ. So less content and the weightage is 7 to 9 marks. Clear? And the last concept, digital finance and role of a regulator. What is the role of a regulator? Customer has to be protected. Yes or no? Customer has to be protected. There are two aspects. The most important two aspects in defining the role of a regulators. First one, consumer protection. Consumer has to be protected. At the same time, they have to take care of competition and innovation. Competition and innovation. The three goals when it comes to consumer protection: ensure consumers are informed. That's why if you are making any transaction or if you are downloading something, they will ask you to accept terms and condition. Ensure consumers are informed. Prevent unfair practices by providers. Unfair practices by providers. Ensure consumers have access to dispute and complaint mechanisms. There should be a grievance redressal. There should be a mechanism. Every fintech company has to provide a mechanism to resolve the dispute of a consumer. Ensure consumer have access to dispute and complaint mechanisms. Clear? So what are the fintech laws and regulations in India right now? They might ask MCQ. Payment and Settlement System Act 2007. This act governs the payment regulation in India. In India, all the digital payments are regulated by Payment and Settlement Systems Act 2007. All the payments. They might ask you MCQ. Which act is regulating the payments in India? Payment and Settlement Systems Act 2007. Next, Master Directions on Issuance and Operation of Prepaid Payment Instruments. Prepaid payment instrument example, wallet. So master directions were issued by RBI. Master directions are issued by RBI on issuance and operation of a prepaid payment instrument. That means who can start the wallet? What are the criteria to issue and operate prepaid payment instrument? Eligibility criteria. Eligibility, time to time. It prescribes the eligibility criteria for prepaid payment instrument issuers. Clear? Okay. Next, NPCI guidelines governing UPI payments. UPI payments are governed by NPCI guidelines. NPCI means National Payments Corporation of India. In Hyderabad, you will find, while going on ORR, Outer Ring Road, you will find NPCI, National Payment Corporation of India guidelines governing UPI payments. In India, UPI payments are governed by what? NPCA. NPCA means National Payments Corporation of India. Next, RBI allowing NBFCs in this phase. NBFCs example, Bajaj Finance, Muthoot Finance, Manappuram, all these are non-banking financing companies. Guidelines regulating peer-to-peer lending platforms. Guidelines governing payment aggregators or gateways. So payment gateway example, BillDesk. Okay. So payment gateways, they have to follow payment intermediary guidelines. For example, Razor Pay, they have to follow these guidelines. What are the guidelines? Payment intermediary guidelines. Anti-money laundering laws. You know the anti-money laundering laws. Prevention of Money Laundering Act 2002. And also the rules and RBI master directions on KYC. KYC means know your customer. KYC means know your customer. And next, acts protecting data privacy and protection. Data privacy. So to protect the data, so we have a Information Technology Act 2000. Okay, and IT rules, Information Technology Rules 2011. These are the two key regulations governing the protection of personal data. Yes or no? In this digital era, so there must be a regulation to protect the data. Yes or no? You and your girlfriend might be chatting. That has to be protected. Yes or no? So we have a Information Technology Act 2000. So that is a fundamental right of a privacy. Constitution has given a right of a privacy. You should not see other mobiles, others chatting. So that is a basic common sense. Next, concept 14. Okay, so they might ask you a question like, what are the challenges for the regulators? What are the challenges for the regulators? Challenges for the regulators. What are the challenges? Governance of the internet economy and the global internet. That is not that easy, yes or no? So nowadays people are abusing in social media. Okay, indecent comments on girls and even on boys also, yes or no? So governing is a difficult task because everybody is having a mobile. Okay, in this internet economy, so governing is a key governance issue. It is a challenging for the regulator. Next, management of intellectual property right with innovation driven competition. For example, non-fungible token. So what we have discussed is a person who is purchasing NFT will get a ownership, yes or no? Okay, and how it get registered, yes or no? That is a digital asset, right? Digital asset means what? That has to be managed. Government has to manage it. Registration has to be done. How the registration will be done? A person who is sitting in registrar office will not be having a knowledge about this. So that is again a challenge for the regulator. Management of intellectual property right with innovation driven competition. Taxation, how the taxes will be levied. Customer privacy, so there is no privacy at all, yes or no? Customer privacy, owning and sharing data. So these are the key challenges faced by the regulator. So this is all about digital finance. I will add few sentences in concept number 14 and concept number 12. I mean, this concept numbers may also change. In digital finance landscape, I will add, okay, so 4 or 5 sentences, that's it. And digital 14, I mean, governance in digital finance. The key governance issues, they might ask you the challenges faced by the regulator. Then you have to write these points. I might add 3 or 4 sentences to this concept. For suppose if I am not adding, go through the study material. Do not wait for me. Clear? With this we completed digital finance. We completed securitization, digital finance, and next concept is IFM, International Financial Management or International Financial Environment. So that is also an important topic. You will get one theory question. They are not asking any MCQ, but you will get 5 marks from that topic. So that was the trend from the past 4 attempts. Okay. So clear. And that is so little bit lengthy topic. Okay. So there are 10 pages. So I will try to cover that topic within 1 hour, or otherwise maximum I will take 1.5 hours. Clear. Next MCQs, let us see the MCQs from digital finance. Thereafter we shall move on to international financial management. Which of the following are the benefits of UPI to the merchant? To the merchant. So in-app payment is the benefit to the merchant. Round the clock availability is the benefit to the customer. Single click authentication is also benefit to the customer. Safe, secured and innovative is the benefit to the bank. Which one of the following is not a digital asset? Digital printing is a digital asset. Website is also a digital asset. Stable coin is also a digital asset. But fintech is not it is a digital financial service. Which one of the following digital asset is a cryptocurrency which is pegged to any reserve asset like a fiat currency, commodity or other cryptocurrency? Stable coin. So these are the past questions. Okay. Fourth one is also a past exam question. Which of the following is not a potential benefit of a CBDC? Which of the following is not a benefit? Keeping track of a transaction is a benefit. Technological efficiency in storing and transacting with reduced cost, benefit. Providing a digital record of every transaction is also a benefit. Scope to commit illegal activities like money laundering, it is not a benefit. Yes or no? So tax evasion, terror financing, we can prevent actually. Which of the following are not the component of digital infrastructure? Stablecoin is not the component of a digital infrastructure because API, cloud service, internet are the components. So this is also past exam question. Which one of the following digital finance technology, technological concept is a type of distributed ledger which provide an order, time stamped and highly secured record of a transaction? Blockchain. Blockchain is a distributed ledger, public ledger. Which one of the following are the components of digital finance ecosystem? Digital money, digital asset. These two are the components of a digital finance ecosystem. Which of the following is not a component? Digital liability is not a component of digital finance ecosystem. Clear?
Hello, hi everyone. Our next topic international financial management. In study material, this topic is mentioned with the name international financial environment. The trend is the last question is theory question, and in that you will get sub questions 3 and one question is from IFM, international financial management. Okay. So international financial management, but there is a possibility that you might get a practical question also. So that question I have already discussed in marathon, that is global depository receipt question. That is a CA final pass examination question. They might ask you in CMI final also. But the trend is in new syllabus, they are asking theory question from international financial management. Okay. So in past three attempts, because first attempt the last question was not a theory question, new syllabus, so four attempts were completed. So first attempt the paper pattern was completely different, okay, and in the last three attempts the questions were asked. First question they have asked about global depository receipt, global depository receipt, and next initiatives of a world bank, initiatives of a world bank, and recent question is lending schemes of a international monetary fund. Okay, you might have heard about international monetary fund these days in the news, yes or no? Because IMF has granted a loan to Pakistan. So under which scheme it has granted a loan to a Pakistan government? Okay. So why IMF has been established, that we are going to discuss. Okay, here. So in the past three attempts, the questions were initiatives of World Bank, next lending schemes of IMF, and features of a GDR, Global Depository Receipt. So these questions. So we have around 27 concepts in this IFM chapter. This is content wise bigger than digital finance and securitization. Okay. So let us discuss this chapter. And this chapter, I mean, little bit linked to Forex. Only a small link. Small link, okay? You need not worry. So you can consider this as entirely a new chapter. It's International Financial Management. Shall we start? So IMF, I mean, International Financial Management. What is this International Financial Management? So due to globalization, so what happening is Indian companies borrowing money outside India, and outside India companies they are borrowing in India. So that is what happening. So for example, Indian company, why do they borrow outside India? So for cheaper interest rate. For cheaper interest rate, they might borrow in okay outside countries. And next, they might issue shares outside India through GDR, through Global Depository Receipts. Okay. So why do they issue shares outside India? For example, there might be limited access to the capital in India. Okay. So people may not have a money to make investment. So that's why what Indian company will do. Indian company will issue shares in US using the concept of a global depository receipt. So first thing we can get capital, more capital. Okay. The second, if a shares are getting listed on New York Stock Exchange, so the brand image will get increased. Yes or no? Brand image will get increased. So that is why nowadays companies accessing capital, they are getting capital outside countries, abroad. Okay. So international financial management or international financial environment. International financial environment includes international financial institutions, I mean the institutions which will provide a loans, and international financial markets, international financial markets. So for example, let us assume a company wanted to borrow money outside India. Okay. Or for example, country, for example, Pakistan has taken a bailout loan 25 times. Actually, IMF is a generally popularly known as lender of a last resort. Lender of a last resort, but for Pakistan it is the only resort. So it used to take loan frequently from IMF. Okay. So countries may take loan from International Monetary Fund. As of now, India does not have any outstanding loan with International Monetary Fund. It has repaid all the debt. Okay. So now the point is countries may need money. Okay. For example, it may need money for clean air initiative. You know that Delhi is most populated city. Okay. So Delhi require a clean air. So to bring that clean air, so we need to invest some money, yes or no? So World Bank may give a loan to It's Delhi government for that purpose. Clean Air Initiative. Okay. Poverty reduction. Poverty reduction. For that purpose, World Bank may give a loan. Okay. So this World Bank, IMF, all these are formed after World War II. So to cooperate each other. So how these International Monetary Fund will get loan, get money, World Bank will get money because IMF has to give a loan. To give a loan, there must be some money. So this money is contributed by the member countries. Member countries will be contributing the money. For example, during the war, IMF has granted loan to Ukraine. During the war itself, IMF has granted loan to Pakistan. There is a threat that they might use this money for war. But the purpose of loan is not to use this money for war. Okay? But still they might use what? This money for war. So despite of all these facts, why the IMF is giving a loan? Because the behind granting this loan, the role being played by US, because US is the most powerful nation in IMF and World Bank, and most of the head of these institutions will also be from Western countries, mostly from Western countries only. Okay, so that's why they will be influencing these loans. So the point is, if a Indian company or Indian government wanted to take like loan from outside, there must be some institution or intermediary. Yes or no? So such institutions are called as international financial institutions. That means institutions which are formed by two countries or more than two countries. These are called as international financial institutions. So International Monetary Fund is one such institution because member countries are 190. World Bank, Regional Development Bank, National Development Bank, and other regional financial institutions. There are several financial institutions, international financial institutions. So now, is this enough? International financial institutions are enough? No. In international financial environment, you will be finding international financial markets as well. What are these international financial markets? Foreign exchange market, because you might be taking a loan in dollars. Thereafter, you should convert these dollars into Indian rupees. Further, you require what? Foreign exchange market. You know that again, foreign exchange market includes spot market and forward market. Next, international money market. Instead of borrowing from financial institutions, Indian company may issue bonds in Japan. Okay. So international money market. International money market. So debt market which is having a maturity less than 1 year generally. International credit market. International bond market. And international what? Stock market. International stock market. As I have already told, for example, Infosys is listed on New York Stock Exchange. It's international. Okay. So nothing but Indian companies will borrow, will issue equity shares in US through the concept of GDR, Global Depository Receipt. So, international financial environment, it includes not just the international financial institutions, it also includes what? International financial markets. And international financial markets includes foreign exchange market, money market, credit market, bond market, stock market. So bond market again, it's okay. Money market means generally the securities will have a maturity less than 1 year. Clear? So let us start the international financial institution. International financial institution play the role of facilitator. They might facilitate a loan and they will act as an intermediary. They will act as an intermediary. IFIs are the creation of multiple nations. Although some bilateral financial institution, bilateral means only two countries are involved. For example, if you have observed the news, especially not the Telugu channels or a regional channels, if you see the English channels, that too reliable channels, Indian government is stressing one point. Jammu Kashmir is a bilateral issue. It does not require any third party involvement. Bilateral, bi means two. So that is the issue between Pakistan and India. They have to decide. So nothing to do with US. and Bangladesh is coming in between and they are asking, so if they need help, we negotiate or we mediate. So that is a bilateral issue. Bilateral means what? Two. So IFI, international financial institutions, are creation of multiple nations. Although there are some bilateral financial institutions do exist, so they also created by two countries. They are also termed as what? IFIs. So generally IFIs are creation of two or more nations. The idea of international financial institution was conceived under Bretton Woods system post the World War II. After World War II, in Hampshire, USA, New Hampshire, USA, the representatives of 44 countries assembled in 1944 and they established a new monetary system which addresses the issues, and that system is called as the Bretton Woods system. Why it is called as Bretton Woods system? Because the 44 countries assembled in Bretton Woods, New Hampshire, USA. So that's why that system is called as Bretton Woods system. Clear? So international financial institution. Immediately after 1944, two institutions were formed. One is International Monetary Fund and the second one is World Bank. So International Monetary Fund. Let us talk about International Monetary Fund. This question was asked in December 2024. IMF was conceived. Conceive, you know the word conceive, right? I mean, it born in July 1944 at the United Nations Bretton Woods Conference in New Hampshire, United States. And IMF is governed by and accountable to its 190 member countries. IMF three main functions are overseeing economic development, lending and capacity development. Economic development, lending. So IMF function, one of the main function of IMF is lending. So what is the purpose of lending? Economic development, to develop the low income countries, and to develop the capacity of underdeveloped countries. So that is the function of IMF. Okay. So the question was, December 2024 question was lending schemes of IMF. Lending schemes of IMF. So now let us discuss the lending schemes of IMF. Generally, we divide the countries into what? Developing countries, developed countries, and underdeveloped countries. Yes or no? But whereas IMF category is different. IMF category is different. So what are the different categories of countries as per the IMF? Low income countries. Low income countries. Can anybody say an example for low income country? Okay, let us think about low income country. And next, lower middle income country. Please close the door. Lower middle income country, upper middle income country, and high income country. High income country. So there are four categories actually. Sir, whether we should know this category, you need not write in examination, but here we are going to discuss the schemes, the various schemes of IMF, International Monetary Fund. Why we should know this category? Because the reason is, not every loan is given to the developed, high income countries. So few loans are available only for low income countries. So for example, four categories. High income, obviously, as you guess, US is a high income country. Germany is a high income country. Examples. Okay. Upper middle income country. Upper middle income country. China is an middle income country. Okay. And next, lower middle income country. In this category, India comes under lower middle income country. Okay. So to be surprised, Pakistan is also what? Low middle income country. So what about low income country? So low income country, for example, so these African countries, okay, Somalia. Somalia is a low income country. Somalia is a low income country. Okay. So you might get confused with these lending schemes. Be careful. You have to read once or twice. But there are less chances you may not get this question for June 2025 because recently this question was asked. First agreement, standby agreement. First scheme is standby agreement. What is the standby agreement? Countries can borrow at the first indication of its possible need. First indication. First indication means what? They can, in the first instance itself, it can borrow. Instantly the loan will be given. What is this? Standby agreement. Next is standby credit facility. It is similar like standby agreement, but for low income countries. Sir, what is the difference? Standby arrangement and standby credit facility. Standby arrangement is the loan given to all the countries, but standby credit facility is given only to the low income countries. Sir, what is the difference? Simple. For low income countries, nominal interest will be charged by IMF or zero interest will be charged. Zero interest will be charged. This is standby credit facility. Next, extended fund facility. Extended fund facility means when a country faces serious medium term balance of payment problems. You know the balance of payment, right? You might have gone through the FEMA Act. If a country is facing a medium term balance of payment problems, the IMF can assist through an extended fund facility. Medium term balance of payments. Okay. Extended credit facility. It is also a similar one, but this is given to what? Low income countries only. Extended credit facility. Generally for low income countries you will find credit. So the extended credit facility, it is a main tool for providing medium term support to low income countries. Sir, under which category? Okay. The loan is given to IMF. The loan is given by IMF to Pakistan. Okay. Let us discuss the lending schemes then. So under what category the loan is given by IMF to Pakistan, we shall discuss. Okay. So extended credit facility is the medium term support given to low income countries. Flexible credit line. Flexible credit line. This is given to the countries which are facing a cash crunch. Cash crunch. They don't have a cash. They don't have a liquidity. Precautionary and liquidity line. Precautionary and liquidity line. So this is designed to meet the liquidity needs of a member countries with sound economic fundamentals. Flexible credit line is given to all, but precautionary and liquidity line is given to only the countries with sound economic fundamentals. So they have a sound economic fundamentals, but what they are facing a liquidity issues, then this loan is given. Okay, clear? Rapid financing instrument. Rapid financing. Rapid. The name itself indicates. Rapid means fast. Rapid means fast. Okay, it is available to the countries facing an urgent balance of a payment. Urgent balance of a payment. Rapid credit facilities, as you expect, if credit comes, so the similar to rapid credit. Okay, rapid credit facility is similar to what rapid financing instrument, but it is provided to low income countries. Low income countries which faces a urgent balance of a payment. Be careful, it is urgent balance of a payment. But the above one is what extended credit facility is. When a country faces serious medium term balance of a payment. Medium term balance of a payment. Are you getting my point? Now, the question is, IMF has granted a loan to Pakistan under which category? Simple. The loan is granted under extended fund facility, I think. Extended fund facility. Because Pakistan is facing a medium term balance of payment, not the urgent balance of payment, because they have a foreign currency reserves which are enough for 3 months. 3 months. For suppose if it is payment, urgent balance of a payment, they might have granted a loan under a scheme, rapid financing instrument. So Pakistan is not a low income country. Pakistan is a lower middle income country. Am I clear? So these are the lending schemes. Now let us discuss about World Bank. This question was asked in December 2023. So World Bank also the same. It was established in July 1944. Okay, and the structure is cooperative. The countries, it is similar to World Bank, IMF, these are similar to cooperative society, operated for the benefits of its members countries. So World Bank includes, so 5 types of a financial institution. First one, the International Bank for Reconstruction and Development. International Bank for Reconstruction and Development. So the purpose is to lend governments of middle income and credit-worthy low income. Credit-worthy low income means they don't have a money, but they are credit-worthy. We can believe in them. So low income, but what? For example, Pakistan and Sri Lanka. So when compare you Pakistan and Sri Lanka is what? Credit-worthy. So they might have a low income. Actually, it is not having a low income. It is not a low income country, but for comparison, I am saying, when you compare our neighbor countries, so when compare Pakistan and Sri Lanka is what? Credit worthy. And even Bangladesh is what? Credit worthy than Pakistan. I am not saying it is completely credit worthy, but comparatively. Okay? And International Development Association provides interest-free loans and grants to government on the poorest countries. Here the assistance is given to what? Poor countries. Above case, assistance is given to middle income and credit-worthy low income countries. The International Finance Corporation, this is established exclusively for private sector, not for governments. The focus will be on a private sector. Multilateral Investment Guarantee Agency. Multilateral Investment Guarantee Agency purpose is to promote foreign direct investment into developing countries to support economic growth, reduce poverty and improve people's lives. Nothing but a US company wanted to make an investment in India. So but they might have a fear. Okay, so what happens to our investment? Yes or no? So this multilateral investment guarantee agency will give a guarantee. If something happens to our investment, we are there, we will repay your investment. Next, the International Center for Settlement of Investment Disputes. If there is any dispute between the host country and the country which is investing, if there is any dispute, we have a International Center for Settlement of Investment Dispute. So what is the purpose of this International Center for Settlement of Investment Disputes? Simple. We have a concept of arbitration, you know. Arbitration, conciliation and arbitration. Conciliation and arbitration is the concept. Instead of going to the court and settling the matter in the court, because it will take time. It will take what? Time. Okay. So that's why instead of going to the court and wasting the time and money, so we might go for what? Arbitration. Conciliation, arbitration, mediation, all these are synonyms but not exactly the same. So that actually we discuss in Arbitration Act, Conciliation and Arbitration Act. So we don't have that act in our syllabus. The concept is to reduce the workload on a court and to save the money of the client, I mean the victim. Clear? Save the money and time. That is the purpose. So that's why if there is any dispute between two countries, that can be settled in the International Center for Settlement of Investment Dispute. Clear? So, next, the major initiatives of the World Bank. The December 23 question is, what are the initiatives of a World Bank? First one, poverty reduction. Obviously. So, World Bank, the major initiative was poverty reduction. Nothing but World Bank will be giving assistance to what? Okay, countries to reduce the poverty. Global partnership, like together with the World Health Organization, and the World Bank administers the International Health Partnership, and protect from the adversities of climate change. You know that right now global warming is the biggest challenge before the world. So protecting the adversities, the negativities of climate change. For example, World Bank will be giving loan to Pakistan for what? To protect adversities from the climate change. Clear up. Next, food security. The World Bank also took slew of measures, including Global Food Security Program in 2010. Clean Air Initiative. World Bank initiative to advance innovative ways to improve air quality in the lives. Okay. And next, open data initiatives. Open data initiative means World Bank will collect and process large amount of data and generate them on the basis of economic models. I mean, this information will be made available to everybody. Open data initiative. Next, open knowledge repository. Open knowledge repository means nothing but, for example, World Bank what will do is, for example, if you have acquired some knowledge, so you might have seen a recently released movie, Telugu movie, Anaganaga. Okay. So in that movie, that person used to tell the concept in the form of stories. Instead of telling the subject directly, that hero will be what? Telling the subject in the form of stories. For example, to explain lunar eclipse, solar eclipses. For this, he will be creating a story. So what he does in that movie is, he has written a book. Stories, which will explain the subject. So the point is, this is a knowledge. This is a knowledge. This book will be collected by the World Bank, and it will be what? It will be made available to all. Repository. Repository means nothing but the knowledge from all parts of the world will be collected, and this will be made available to what? Everybody. The World Bank hosts the Open Knowledge Repository as an official open access repository for its research outputs and knowledge products. Clear? These are the initiatives of what? World Bank. And next, Regional Development Bank. So less chances they may not ask this question, because there are, in study material also they have just mentioned what are the regional development banks. That's it. Regional development banks provides funds for the financing of manufacturing, mining, agricultural, infrastructure projects essential for development. Generally, the repayment terms of a loan are over a 5 to 15 years period at a favorable interest rates. There are several regional development banks. European Investment Bank, you know that Asian Development Bank, right? Regional. These are not throughout the world. They are only regional. If you see the Asian Development Bank, the name itself indicates the purpose is to develop Asia. African Development Bank, Atlantic Development Group of Latin America, Inter-American Development Bank, European Investment Bank, Arab Fund for Economic and Social Development, Arab Fund. That means purpose is to help Arab countries. European Bank for Reconstruction and Development. So these are regional. IMF and World, they are worldwide. Okay. But whereas regional development banks, they are, they will be helping only a part of the world. Clear? So they might ask you to mention the regional development banks. Okay. National development banks. National development banks or other regional financial institution. Again, So this is also, I mean, is not in order in study material, but I have summarized. Some national development banks concentrate on a particular industry or a region, particular industry. Others are multi-purpose. Others are multi-purpose, but these are what they will be concentrating on particular industry or a region. Okay. So, for example, regional financial institutions are financial institutions of neighboring countries established themselves internationally to pursue and financing activities in areas of mutual interest. Most of them are central banks. Most of them are what? Central banks. Example includes the Bank of International Settlement. It was established in 1930. It is owned by 63 central banks. The bank is owned by 63 central banks. Central bank means RBI for India, Federal Bank for US, representing countries from around the world that together account for about 95% of world GDP. European Investment Bank, it is owned by European Union member states. International Investment Bank, International Investment Bank, it was located in Budapest, Hungary. And the European Central Bank, it is the prime component of Euro system and the European system of central bank. Clear? So with this we have completed what? International financial institutions. Next concept, international financial markets. International financial markets are the markets that operate worldwide and facilitate what? International trade and finance. For example, before this class I have seen a news. What is the news? Mangoes worth rupees 4 point something crores rejected by US government. I mean, the mangoes were exported from India, okay, but they were rejected, okay. So the worth was around 4 point crore, so 4.5 crore rupees. That is a small news only. The point is, generally when you export the mangoes, you will get money in dollars. You should convert these dollars into what? Indian rupees. First of all, it is called as what? International trade. International trade, because you are exporting goods to foreign. So the international financial market is the market that operate worldwide and facilitate international trade and finance. These markets can be broadly classified into, beginning itself we have seen foreign exchange market, international money market, international credit market, international bond market, international stock market. So foreign exchange market we already know. We have already discussed in what? Forex chapter. Foreign exchange market allows currencies to be exchanged. Yes or no? No stock is traded in foreign exchange market. Only the currencies are allowed to be exchanged in order to facilitate international trade or a financial transactions. Simple. If you are exporting mangoes, you will get money in dollars. Convert these dollars into rupees. Yes or no? Likewise, if you are taking a loan from, okay, see, if Indian government is taking loan from World Bank, then what? The loan will be given in dollars, it has to be converted into rupees. Nothing but allows currencies to be exchanged in order to help international trade or financial transactions. Okay? Clear? So for example, Indian government has banned import of a garments from Bangladesh recently because they are doing some extra, so that's why. So the point is international trade. Bangladesh is selling garments to India. And Bangladesh, the major component of a GDP is textile. Next, the foreign exchange market has a two broad segments: spot market, forward market. You know already, spot market means if you want to buy the foreign currency in the spot, then you will be entering into contract in spot market. And we have a concept of forward market. If you want a foreign currency in the future, if you want to buy or sell foreign currency in the future, then you have to fix the rate now itself. For that we use forward market. Generally the forward market is used by the hedgers. Hedger means a person who wanted to reduce risk. Clear? International money market. International money market. The growth in international business has caused the growth in, see the point, the growth in international business has caused corporations or governments in a particular country to need short term funds denominated in foreign currency. Okay, companies or a government, they needed short term funds denominated in foreign currencies. So there may be actually three possibilities. There may be three possibilities. I mean, why do they borrow from outside? Okay, first reason, because they have to pay in foreign currency. They have to pay in foreign currency because they are importing goods from outside India, and the billing is done in foreign currency. So instead of borrowing in Indian rupees and converting them into foreign currency, they might directly borrow in foreign currency and pay off the money to supplier. First reason. Second, if they need funds to support local operations, they can take loan in local market also, but the interest rate may be lower in outside countries. Clear? So that might be the reason. Third reason, they may consider borrowing in currency that will depreciate against their home currency so that they can repay the loan at a more favorable exchange rate. So simple common sense point. I have an expectation that, for example, dollar value will get decreased to 50 rupees. For example, let us assume, okay, in next 1 year, okay, dollar rate will get decreased to 50. So this is my expectation. If it is my expectation, what I will do is I will borrow in US $1,000. I will convert this $1,000 into Indian rupees. Right now $1 is equal to approximately 85. So 1000 into 85 you will get 85,000. But while repaying, okay, I am expecting that by the time I repay the loan, dollar value will depreciate against my home currency because $1 will get reduced to 50. So then what happens? 50 into 1000. Forget about the interest. So when I repay the loan, so my outflow will be 50 into 1000, that is 50,000. So that might be the reason. So why do we borrow outside? The preferences of corporation and governments to borrow in foreign currencies and of investors to make short-term investments in foreign currencies resulted in the creation of international money market. What is this actually? So Indian company wanted to borrow outside India. Indian company wanted to borrow, or Indian government wanted to borrow in foreign currency. At the same time, the investors, they wanted to make a short-term investment in foreign currency. That has resulted in creation of what? International money market. Simple. Both sides. Next, in international money market, we have a concept of European money market. European and Asian money market. Again, this European. So tell few names. European money market. So you might Euro is different from European. Euro is different. Euro dollars are different. Euro dollars are different. Euro is a German currency. Euro is a German currency. Be careful. European money market. The origin of the European money market can be traced to the Euro currency market that developed during 1960s and 1970s. Euro money market. Actually, the origin can be traced to, what is the link? First European currency market was developed, and thereafter European money market. Euro currency market means what? Currency market. Currency market means it allows the currency to be exchanged. From Euro currency market, European money market was established. To conduct international trade in European countries. So tell me few European countries. Spain is a European country, right? Germany is a European country. France, European country. So to conduct international trade in European countries, the companies in US, they used to deposit US dollars in European bank. Are you getting my point? Ford company, it is depositing dollars in European bank. The banks were willing to accept the deposits because they could lend dollars to corporate customers based in Europe. Banks also started accepting the dollars. Why they started accepting the dollars? Because so that they can give loans to the customer who are in Europe. That was the reason. So that's how the euro currency market was started. Euro currency market means nothing but what? Depositing of dollars in European banks. That's how the euro currency market was started, and from then European money market was developed. These dollar deposits in banks in Europe and other continents as well came to be known as euro dollars. You might get confused. Euro dollars means what? Nothing but dollars deposited in European banks. Dollars deposited in European banks are called as euro dollars. And the market for euro dollars came to be known as euro currency market. Clear? Euros are different. Euro is a currency of Germany. Euro is a currency of Germany. Euro dollars means nothing but what? Dollars deposited in European banks. The market for euro dollars came to be known as euro currency market. Clear? Clear? So European banks taking dollars from US companies. Why it started accepting the dollars? So that it can give loans to the customers based in Europe. So thereafter they started giving these dollars to what? Asian countries also. Because Asian countries, they are importing oil from Arab countries. They need to make payment in dollars. So that's how the euro currency market was developed. Next, Asian money market. It is similar to what? European money market. The Asian money market originated as market involving most dollar denominated deposits. Again the same. Here the dollar is being deposited in Asian banks. That's it. Hence it is originally known as Asian dollar market. These businesses could not rely on banks in Europe because of distance, different time zones. So today the Asian money market, as it is now called, and is centered in Hong Kong and Singapore, where large banks accept deposits and make loans in various foreign currencies. Actually initially it started with dollars, but later on what, they are accepting deposits and giving loans in various currencies. Manufacturers are the major borrowers in the market. Manufacturers are the major borrowers in the market. Clear? Next, international credit market. International credit market. So credit is different. Money market is different. Money market is different from credit market. So what is a credit market actually? Taking loans. Money market means instruments are issued. Money market instruments. Money market instruments are issued. Both are ultimately loans only, taking debt only. Okay. International credit market. MNCs and domestic firms often obtain medium-term loans through term loans from local financial institutions. Generally, they used to take loan from local financial institutions. However, MNCs also has access to medium-term funds through bank located in foreign markets. Loans of 1 year or longer offered by banks to MNCs or government agencies in Europe are commonly called as Euro credits or Euro credit loans. Clear? The loans offered in Europe are commonly known as what? Euro credits or Euro credit loans. And generally maturity will be more than 1 year. If maturity is less than 1 year, money market. These loans are provided in Euro credit market. The loans can be denominated in dollars or many other currencies, commonly have a maturity of 5 years. And the loans are offered at floating rate. The loans are offered at floating rate. Why do they offer loan at floating rate? This is because bank accepts short-term deposits and sometimes provide long-term loans. Are you able to understand what is this floating rate? The interest rate keeps on changing. Sometimes what happens is bank accept short-term deposit, and give long-term loan. So that's why the interest charged will be floating rate. Nothing but, for example, Salman Khan has taken a loan. Okay, Salman Khan has taken a Salman Khan. Okay, bank has accepted a loan from Salman Khan. Short-term deposit accepted by the bank, and the interest rate is 6%. Interest rate is 6%. Bank will pay 6% to Salman Khan. Now, bank has given this amount okay, to Prabhas at the rate of 8%. Long-term loan. I mean, loan is given for a period of 10 years. Now tell me, actually, bank is paying 6% to Salman Khan, collecting 8% from Prabhas. What is the benefit? 2%. Done. But what about this term? 6 months and 10 years. Yes or no? First, suppose the bank has repaid the deposit to Salman Khan by accepting deposit from the other person. Ram Charan. Okay. Now the point is, Ram Charan, he deposited money with bank, and the bank is paying interest of 9%. Because interest rates in the market has got increased. So Ram Charan expecting 9 and bank is also paying 9. But what is the interest collected from Prabhas? 8%. If a bank is fixing the rate of interest to Prabhas, then it might lose money. Yes or no? Because it is accepting short-term deposit and giving a long-term loan. If interest rates increases in the market, the bank will be losing money. So that's why instead of giving loan to Prabhas at a fixed rate like 8%, it will give a loan at floating rate. If interest rate in the market increases, then the interest rate for Prabhas will also increase. For example, you might have heard about LIBOR, London Interbank Offer Rate. MIBOR, Mumbai Interbank Offer Rate. Whenever this base rate increases, the overall interest rate will also increase. Clearer? So that's why these loans are generally issued at floating rates. International credit market is well developed in Asia and is also developing in South America. Periodically, some regions are affected by economic crisis, which increases the credit risk. So this is what international credit market. Next, international bond market. So MNCs like domestic firms may obtain long-term debt by issuing bonds in their local market. They can also access long-term funds in foreign markets. Don't get confused, okay? You want money, yes or no? You have a concept of money market. Money market means maturity less than 1 year. Second concept, credit. International credit market. You can take loan from financial institutions outside India. Okay, and maturity more than 1 year. And instead of getting loan from the financial institutions, we can go for bond. We can go for what? Bonds. International bond market. Okay. Although MNC like domestic firms can obtain long-term debt by issuing bonds in their local markets, they can also access long-term funds in foreign markets. Institutional investors such as commercial bank, mutual funds, insurance companies, pension funds from many countries are major participants in international bond market. For example, Indian company is issuing bonds in other country. So who are going to invest in this Indian company bonds? Insurance companies of other countries, pension funds of other countries, mutual funds of other countries, commercial banks of other countries. Institutional investors. Okay. So these are called as foreign institutional investors. International bonds are typically classified as either foreign bonds or euro bonds. Simple. Be careful. International bonds can be classified as foreign bonds or euro bonds. Foreign bond means a bond issued by the borrower. Issued by the borrower. If Indian company is issuing bonds, so Indian company is a borrower, yes or no? Is foreign to the country. Is foreign to the country where the bond is placed. For example, US company is issuing bonds in Japan. Okay, US company is issuing bonds in Japan denominated in Japanese yen. Here, who is the borrower? US company is the borrower. Where the bonds are being issued? Bonds are being issued in Japan. Okay, so for Japan, okay, borrower is a foreigner, yes or no? Foreign bond is issued by the borrower foreign to the country where the bond is placed. Are you getting my point? For example, US company Ford issuing bonds denominated in Japanese yen to the investors in Japan. Am I clear? Next. So bonds are denominated in what? Japanese yen. What about euro bond? Euro bonds are the bonds which are sold in countries other than the country of the currency denominating the bonds. Example, bonds denominated in dollars issued in Japan. There is a difference between foreign bond and euro bond. Am I clear? Euro bond means what? Euro bond means the bonds are sold in countries other than the country of the currency denominating the bond. For example, bond is denominated in INR. These bonds are being issued in Japan. Then it is a euro bond. Okay, INR bonds are issued in China, euro bond. INR bonds are issued in US, euro bond. Clear up? Dollar denominated bonds are issued in India. Denominated bonds issued in India. So that is what foreign bond to India. Am I clear? Okay. Next, euro bond market. Euro bond market. Generally, might ask you types of bonds. Euro bond market. The emergence of euro bond market was partially the result of the international equalization tax imposed by US government in 1963 to discourage US investors from investing in foreign countries. What happened is US government discouraged US investors from investing in foreign securities. Therefore, non-US borrowers that historically had sold foreign securities to US investors began to look elsewhere for funds. Okay, that's how the euro have become very popular as means of attracting funds because they do not have a registration requirements. Am I clear? Next, international stock market. International stock market. MNCs and domestic enterprises obtain long-term funding by issuing stocks locally. Generally, the stocks are issued at local market. However, MNCs can also attract fund from foreign investors by issuing stock in international markets. Yes or no? Investors in a foreign country are only willing to purchase stock if they can easily sell their holding of the stock locally in the secondary market. Yes or no? Yes or no? So, for example, Coca-Cola company, it wanted to raise fund from German citizens. Okay. So, what German people will need? German people, they wanted to have a flexibility. I mean, if they don't want the security, they should be able to sell them easily. Now tell me, if a Coca-Cola stock is denominated in dollars, will the German investors will get attracted? No. Why? Because they cannot easily sell those stocks because stock is denominated in dollars and German currency is euro. Clearer? So investors in a foreign country are only willing to purchase the stock if they can easily sell their holdings of the stock locally in the secondary market. So that's why the stock is denominated in the currency of the country where it is placed. For suppose if Infosys is issuing stock in US, the stock has to be denominated in US dollars. So for example, Coca-Cola stock issued to investors in Germany is denominated in euros. Non-US corporations that need large amount of funds sometimes issue stock in United States. These are called Anki stock offerings due to the liquidity of the new issue market there. Generally, non-US corporation, many of the Indian companies has raised fund outside India, especially in US. Next, non-US enterprise also obtain equity financing by issuing American depositories, which are certificates representing bundles of a stock. This concept we are going to discuss in detail. American depository receipt. One concept is directly issuing shares to the investor. For example, Infosys is issuing shares to Mr. John in US, Mr. Donald Trump in US, okay, Mr. JD Vance in US. So this is directly issuing shares to the what investor. So we have another concept. Non-US enterprises they might what obtain equity financing by using American depository receipt. So what is the concept of this American depositories? If you want to list your stock directly on a stock exchange, if you want to directly issue the stock directly to the investors in US, lot of disclosure requirements, lot of regulatory requirements. Yes or no? So to bypass these regulatory requirements, what the companies will do is, company will be issuing shares to the depository banks outside India. Let us say for example, okay, so X Limited in India issuing shares to the Citibank, US Citibank. So all the shares are allotted to the US Citibank, and this US Citibank what it will do is, it will keep the shares with Citibank only. Let us say 1 lakh shares were allotted. Now this Citibank will create a depository receipt. For example, depository receipt may be created for every 5 shares, 1 depository receipt. That means 1 lakh shares are allotted to Citibank. So 20,000 depository receipts will be created and will be issued to what? Investors outside India, that is US. If they are issued in US, they are called as American depository receipts. If they are issued in India, Indian depository receipt. For example, US company is allotting shares to State Bank of India, and the State Bank of India is issuing depository receipts to investors in India. Okay, so if Ramajan from Tamil Nadu is investing the shares, if he is purchasing the depository receipts issued by US company or Chinese company, these are called as Indian depository receipts. American depository receipt means what? Indian company issuing depository receipt in US. Okay, but stocks are not directly issued to the investors. Stocks are allotted to depository bank, and this depository bank, 1 lakh shares are allotted to depository bank. This depository bank will create what? Depository receipts against these shares and will issue these depository receipts to investors, so that they can bypass some regulatory requirements, because depository bank will take care of those things. So that again we are going to discuss. Next, euro bonds. Euro bonds. Already we have seen euro bonds earlier. Euro bonds means the bonds denominated in a currency other than that of a country in which they are issued. Example, a bond denominated in Japanese yen issued in UK. Okay. INR bonds issued in US. Or bonds denominated in US dollars issued in France or the UK are examples of what? Euro bonds. Foreign bonds means what? US company issuing Japanese and denominated bonds in Japan. So US company issuing Japanese and bonds in Japan. This is what? Foreign bond, because the bonds are being issued by foreign company. Euro bonds are different. Euro bonds means what? The bonds denominated in a currency other than that of a country in which they are issued. Okay, example, dollar denominated bonds issued in Japan, or Japanese and denominated bonds issued in UK. Clear? Euro bonds should not be confused with bonds that are issued in foreign country but in the same currency as the investor. For example, N denominated bond sold by a non-Japanese issuer such as a French company. This is what? Foreign bond. Yes or no? N denominated bond. Japan currency is N. N denominated bond sold by a non-Japanese issuer such as a French company in Japan. This is what? Foreign bond. You should not get confused with Euro bond and foreign bond. Likewise, US dollar denominated bond sold by a German company in US. German company is selling US dollar denominated bond in US. Then it is what? Foreign bond. Clear? Am I clear? Nothing but if borrower is foreigner, then that is foreign bond. Clear? Done. Next, Euro bond issue structures can be classified into two broad categories: fixed rate bonds or floating rates. Obviously, Euro bonds account for approximately 30% of the global bond market. I am expecting this concept number 17. They might ask you foreign bonds. So you already know what is the foreign bond. Borrower is a foreigner, right? So we have four types of foreign bonds: Anki bond, Samurai bond, Bulldog bond, Shibosai bond. Shibosai bond. Anki bond. These are the US dollar denominated bonds issued by foreign borrowers in the US bond market. Be careful, remember this word. Anki bond. Anki bonds, simple. Anki bonds means, be careful, you might get confused. Anki bonds, you might get MCQ, multiple choice question, or theory. Anki bond, these are the US dollar denominated bonds issued by foreign borrowers. Usually foreign governments or entities, supranational and highly rated corporate borrowers in the US bond market. Example, Reliance Industries Limited has been the most successful corporate to tap this instrument with a 50-year $50 million Anki bond issue in 2013. Anki bond means dollar denominated bonds issued by foreign borrowers in US bond market. Example, Reliance issuing bonds in US dollar denominated. Yes or no? Here Reliance is a foreigner. Reliance is foreign to US because bonds are being issued in US, but issue is being done by foreign company. For US, Reliance is a foreign company, right? So that's why this is a foreign bond, Anki bond. Samurai bond. Samurai bond means these are the bonds issued by non-Japanese borrowers in the domestic Japanese market. Borrowers are supranational and have at least a minimum investment grade rating, A rated. The maturity range between 3 to 20 years. Again the same. If you are issuing the Japanese and denominated bonds, if Reliance is issuing Japanese and denominated bonds in Japan, then it is called as Samurai bond. Am I clear? Done. Next, Bulldog bond. These are the sterling denominated foreign bonds. Sterling means pound. Sterling denominated foreign bonds which are raised in UK domestic securities market. Simple. Yankee US dollar US. Samurai bond Japanese yen in Japan. Okay, bulldog bond pound in UK, and the maturity of these bonds will be either for very short period 5 years or very long maturity 25 years and above. Next, Shibosai bond. Shibosai bond is similar to Samurai bond, but these are the privately placed bonds issued in Japanese market. The qualifying criteria is less stringent as compared to Samurai or Euro N bond. Samurai bond is also called a Euro N bond. The difference between the Samurai bond and Shibosai bond is Shibosai bonds are not issued to the public. They are privately placed. Private placement. So that's why less requirement. Qualifying criteria is a less stringent. Simple. Done. Clear. Next, concept number 18. Foreign currency convertible bond. The name itself indicates. Okay, bonds can be converted into what? Equity. And foreign currency, that means the bonds are issued in currency foreign to the investor. For investor it is foreign. Be careful. Foreign currency convertible bond means currency is foreign to the investor. The name also suggests that the bonds are convertible in nature, indicating that investors not only receive principal and coupon payments, but also an offer of converting their bonds into stocks. Before the maturity, they will be given an option to convert these bonds into certain number of equity shares. So this is a convertible bond. The only difference is currency is foreign to the investors. What are the benefits? Same benefits. I mean, what are the benefits applicable to convertible bond? The same benefits. What is the benefit? Coupon rate. Okay, benefits. The coupon rate of foreign currency convertible bonds are generally less than traditional bank interest rates, reducing the cost of debt financing for the issuer. Obviously, company which is issuing foreign currency convertible bond will be paying a less interest compared to a traditional bank. Why? For example, company is taking a loan from bank, it is paying 8%. But for foreign currency convertible bond, it might pay only 7%. Why? Because they are given conversion option. So that's why interest will be saved. When converted, issuer is able to reduce its debt gains additional much needed equity capital. Are you getting my point? If they get converted, issuer will reduce debt cost. Next, investor have an assured minimum fixed rate of a return. From investor point of view, minimum return guaranteed. Limitations. If the stock market is down, then foreign currency convertible bond demand will decrease, obviously. If converted, ownership will get diluted. Yes or no? And earnings per share will decrease for existing shareholders. If there is an unfavorable move in exchange rate, the principal and coupon payments will become more costly. Because you have to, yes or no? So coupon payments and principal may become costly. Clear? Next, syndicated credits. Syndicated credit means, for example, one bank may not give a loan. Okay, so that's why what they will do is a group of banks will come together and will give a loan. Okay, so syndicated credit. These are the bank loans usually at a floating rate of interest with fixed maturity, arranged by one or more lead managers with a number of other banks participating in the loan. Do not confuse with sentence. Generally, these loans are given with floating rate. interest with a fixed maturity. Arranged by one or more lead manager. One or more lead manager means, for example, Vijay Mallya, he wanted a loan. State Bank of India is the lead manager. But State Bank of India is not the only lender. State Bank of India, what? It has brought the other banks into the group, and they gave a consortium loan, syndicate loan. But the lead manager is SBI. Okay. For example, 10 banks together giving loan to what? Nirav Modi. But out of these 10 banks, 2 banks may be lead managers. They will take a lead. They will bring all banks together. They will collect amount and they will give loan to what? Nirav Modi. Okay. Syndicate banks are of two types: club loan, syndicated loan. Club loan and syndicated loan. What is this club loan? Club loan is a private arrangement between lending bank and borrower. When the loan amounts are small and parties are familiar to each other, lending banks form a club and advance a loan. Clear? So this is done when the amount is small and parties are familiar with each other. This is called club loan, and this is a private arrangement. Syndicate loan means sometimes a single bank may be unwilling to or unable to lend the amount needed by particular corporation. Nirav Modi asking 10,000 crores loan. One bank alone cannot give a loan. In this case, all the banks will come together and will give a loan. But the lead bank is responsible for negotiating the terms with the borrower. Clear? There are two in syndicate: club loan, syndicate loan. Club loan is what? Private arrangement between lending banks and borrower. And one more point is, amount borrowed is small and the parties are familiar with each other. Clear? Next, concept number 20. Euro notes. Euro notes as a concept is different from syndicate bank credit in terms of its structure and maturity period. The documentation formalities are minimal. There are numerous applications of a basic concepts of a euro notes. There are several types of a euro notes. First one, commercial paper. Commercial paper is a short-term unsecured promissory note which repay a fixed amount on a certain future date. Companies may issue out a commercial paper. Commercial paper is one type of euro note. Okay. So it is an unsecured promissory note which repay a fixed amount on a certain future date. Note issuance facility. Note issuance facility is a medium term. It is not a short term, it is a medium term legally binding commitment under which a borrower can issue short term paper of up to 1 year. The underlying currency is mostly US dollar. So the maturity will be up to 1 year. So is a medium term legally binding commitment. Legally binding commitment under which a borrower can issue short term paper up to 1 year. Here the sentence is confusing. So the note issuance facility is also a short term paper up to 1 year. But the point is, underlying currency will be mostly US dollar. Medium term notes defined as sequentially issued fixed interest securities which have a maturity of over 1 year. If a maturity is less than 1 year, commercial paper. Otherwise it is what? Medium term note. Next, euro bond with equity warrants. Euro bond with equity warrant. The bond will carry a coupon rate determined by the market rates, and the warrants are detachable. Equity warrant will also be given, and the warrant is detachable. With that warrant, what if they want, they can exercise the right and they can convert to shares. Next, euro convertible bond. We have seen foreign currency convertible bond. Now it is euro convertible bond. Euro convertible bond means a convertible bond which can be converted into depository receipts or a local shares at a fixed price after the minimum lock-in period. And these euro convertible bonds may be issued with They may carry options: call option, put option. Call option means right of a company to convert the ECB into equity before maturity. Call option, so call option is for whom? It is for a company. Company is having a right to convert the ECB, euro convertible bond, into equity before maturity. Put option means puttable bond. We say puttable bonds. Puttable bond means what? Allows the investor to get his money back before the maturity. He need not wait till the maturity. He can ask back his money before the maturity. It is a puttable bond. Put option. Nothing but euro convertible bond with put option. We can call them as puttable bond. Next, company desirous of issuing euro convertible bond should obtain the prior permission of a Ministry of Economic Affairs, and proceeds of ECB can be applied only for the following: import of capital goods. So this you might have discussed, gone through in FEMA. Import of capital goods, retiring foreign currency debts, repayment of foreign currency debts, capitalizing Indian joint venture abroad, application for working capital, and others is restricted to 25% of total proceeds. Clear? Euro convertible bond money can be used only for what? Import of capital goods, repayment of foreign currency debt, capitalizing Indian joint venture abroad, and application for working capital, and others is restricted to 25% of total proceeds. Euro convertible zero bond. Euro convertible zero bond means simple. You know the concept of zero coupon bond. Zero coupon bond means zero interest. So this is also same. So no interest is payable on the bonds, but the conversion of a bonds takes place on maturity at a predetermined price. If you don't want to convert, then you can take back the amount, but you will not get any interest. If you are not getting interest, it is called as euro convertible zero bond. Done. Next, external commercial borrowings by Indian organizations. External commercial borrowings are loans in India made by non-residents lenders in foreign currency to Indian borrowers. These are used widely in India to facilitate access to foreign money by Indian corporations and public sector undertakings. ECBs are regulated by RBI. So external commercial borrowings includes commercial bank loans, buyer's credit, supplier's credit, securitized instruments such as floating rate notes, fixed rate bonds, etc. Nothing but external commercial borrowings includes euro convertible bond also. Next step. ECBs can be used for investment in stock market, cannot be used for investment in stock market or speculation in real estate. Then, clear? Okay. So external commercial borrowings cannot be used for investment in stock market or speculation in real estate. And this third and fourth point is applicable for what? External commercial borrowings also. External commercial borrowings includes what? Euro convertible bonds as well. Clear? Next, depository receipt. Depository receipt. Sir, what is this depository receipt? Let me explain depository receipt. Simple. If a Reliance company wanted to issue shares in US, one thing, it can directly issue shares to the investors in US, but Reliance company has to take care of all the compliances, regulatory requirements, and it involves a lot of regulatory requirements. Yes or no? And Reliance company, it has to meet the regulatory requirements. So the other way of issuing equity in US is using the American depository receipt. What is this American depository receipt? These American depository receipts are issued by US bank. American depository receipts are issued by US bank. Indian depository receipts are issued by Indian bank. Clear? Okay. Okay. US bank will issue American depository receipts. How the US bank will issue American depository receipt? Simple. Citibank. Let us assume Citibank, US bank. Now, Reliance will be allotting 1 lakh shares to the Citibank. Clear? So, Citibank is a custodian of these 1 lakh shares. Custodian, not the beneficial owner. Of course, the shares are registered in the name of Citibank, but the beneficial owner is ultimately the person who is purchasing depository receipts. So Citibank is the custodian of 1 lakh shares. What the Citibank will do is, Citibank will be creating a certificate called depository receipt. What does this certificate represent? Certificate represent shares of a foreign stock, that is shares of a Reliance. Depository receipt is a certificate that represents shares of a Reliance. How many depository receipts can be created? Depends. For every 2 shares, 1 DR may be created. For every 5 shares, 1 DR may be created. For every 10 shares, 1 DR may be created. Depends. Okay. So for example, 1 lakh shares. And each share, let us assume 100 rupees. Reliance is in India, yes or no? Reliance is in India, listed on Indian Stock Exchange. Let us assume 100 rupees share value. So now 1 lakh into 100. So what is the total worth of shares? 1 lakh into 100, 1 crore. Now 1 crore divided by 85. 85. What is this 85? Let us dollar exchange rate. Dollar exchange rate. Because the depository receipts are not issued in INR. Depository receipts are issued in dollar denomination. Because these are issued by what? Bank in US. Invested by investors in US. Obviously, they will be purchasing this deposit receipt in dollar. So that's why 1 crore divided by 85, then you will be getting a dollars. Am I clear? Are you getting my point? So instead of that, you can say like 100 divided by 85. 1 share worth is 100 rupees. 100 divided by 85. So that is the issue price in US. Deposit receipt issue price. But 100 into, you should do, if 1 share represent 1 deposit receipt, then 100 divided by 85. For suppose if 1 deposit receipt is created out of 5 shares, then 5 into 100 divided by 85. If deposit receipt is created by using 2 shares, then 2 into 100 divided by 85. And if a company has decided to issue the deposit receipt at 10% discount, then what? 2 into 100 into 90% divided by 85. That will be the issue price. Clear? So Reliance will allot 1 lakh shares to Citibank. Citibank will create depository receipts and will issue to the investors in US. This concept is called what? American depository receipts. These foreign shares are usually held in custody overseas, but the certificate trade in US. Through this system, a large number of foreign-based companies are actively traded on one of the 3 major US equity markets. The uses of ADR skip some disclosure requirements imposed on stock offering in the United States that enables non-US firms to tap the US market for funds. So that was the point actually. Clear? Done? So global deposit receipt includes ADR. Global depository includes ADR, IDR. Global depository receipts. Global depository receipts are issued by international investment banks as a certificates which represent the foreign shares but can be traded on the local stock exchange. Example, UK investor may be able to buy shares in Vietnamese company via GDR issued by UK Investment Bank. The GDR will be denominated in GB pounds and will be tradable on the London Stock Exchange. If you observe this, if you replace dollar in place of pounds and US in case of UK, then that is American depository receipt. Yes or no? Yes or no? UK investor, nothing but US investor, may be able to buy shares in an Indian company via GDR issued by US Investment Bank. The GDR will be denominated, nothing but the ADR will be denominated in US dollar and will be traded on US Stock Exchange. The investment bank, Citibank, takes care of foreign currency, foreign taxes, etc., and pay dividend on the GDR, on the ADR in US dollar. Clear? You might get confused between ADR and GDR. ADR and GDR are similar concepts, okay? GDR, Global Depository Receipt. A GDR will be will be used to access two or more markets, usually London and US. Clear? So features of GDR. Features of GDR. Underlying shares. Each GDR may represent, as I have already told, one or more underlying shares. Nothing but one depository receipt may be created out of. One depository receipt can be created out of what? One share. Or one depository receipt may be created out of 2 shares or 5 shares. So each GDR may, this one is I think June 24 question. June 2024 question. This question was asked, features of GDR. Underlying shares. Each GDR may represent one or more underlying shares which are physically held by the custodian appointed by the depository bank. Entry in company's books. In company's books, the depository bank name appears as the holder of a shares, as I have already told. In the books of Reliance, Citibank name will be mentioned, not the beneficial owner, not of Mr. Donald Trump or JD Vance. So those names will not be mentioned in Reliance company books. Okay, in the company books, the depository. Okay. Next, returns. Depository gets the dividend from the company, obviously, in local currency. Reliance company will pay what? Reliance company will pay INR to Citibank because Reliance is in India. So dividend is paid in INR to Citibank and distributes them to the depository bank will distribute them to the holders of a depository receipt after converting them into dollars at the ongoing rate of a exchange. If deposit receipts are issued in UK, then Reliance will pay INR to UK bank. UK bank will convert these INR into Great Britain pound and will pay to the investors, original investors. Clear? Negotiable. GDRs are exchangeable with the underlying shares either at any time or after the lapse of a particular period of a time, generally 45 days. GDRs are exchangeable with the underlying shares. Next, globally marketed. GDRs are marketed globally without being confined to borders of any market or country, as it can be traded in more than one country. So the only difference between ADR and GDR is ADRs are issued only in America. GDRs means they can be issued in more than one country. If they are issued in more than one country, they are called as global depository receipts. So that means global depository receipt includes what? ADR and IDR. Next, warrant. Next concept is what? Warrant. Warrant is a security that entitles the holder to buy an underlying stock of the issuing company at a fixed exercise price until the expiration date. Some important characteristics to consider include the following. Okay. So what is a warrant holder? Warrant is similar to what convertible bond, but warrant holder will not get any interest. Warrant holder will not get any interest. Okay, warrant holder will get only an option to exercise, only an option to buy an underlying stock of a company at a fixed exercise price until the expiration date. So warrant holder will have a right to buy the stock until the expiration date at a fixed exercise price. But convertible bond is what? Convertible bond is also same, but he will get interest. If he don't want, okay, to convert the bond into equity shares, then he will get back his principal. But that is not with the warrant. A warranty is exercised when the holder informs the issuer of their intention to purchase the shares underlying the warrant. Obviously, the holder informs the issuer. Holder has to inform the issuer that his intention to purchase. Then that means the warranty is exercised. Warrant premium represents how much extra you have to pay for your shares when buying them through the warrant as compared to buying them in the regular way. So that is called as what? Warrant premium in SPMBV. So one of the most frequently asked question, warrant premium. Warrant premium is simple. Whatever the amount you are paying extra is called as what? Warrant premium. Instead of purchasing the shares regular way you can purchase the shares. Instead of purchasing in a regular way, you are paying through a warrant. Okay, and you are paying some extra amount, share warrant. You are paying extra amount for share warrant. That extra amount is called as what? Premium. Okay. If you go through the business valuation marathon, then you will get to know. So there is a practical question on this. Next, like options, here also we have two types. American warrant, European. American means what? It can be exercised anytime before expiration. European means what? It can be exercised only on expiration date. Only on expiration date. European call option, American call option. American call option means it can be exercised anytime before expiration. European means can be exercised only on expiration. Clear? Next, foreign investment in Indian stock market through participatory note. Okay, it is similar to IDR. Foreign investment in Indian stock market through participatory note. Okay, what is this participatory note? Participatory notes are issued by registered foreign institutional investors to overseas investors who wish to invest in Indian stock market without registering themselves with the market regulator, that is SEBI. Okay, registered foreign institutional investors. Foreign institutional investor. You might have gone through this concept in FEMA law. Foreign institutional investor, registered means registered with SEBI. First of all, there is a financial institution, foreign financial institution. It has already registered with SEBI. Okay, say for example X has already registered with SEBI, and X is investing in Indian stock market. Now the other financial institution Y, it wanted to invest in Indian stock market. So now again this Y has to register with what? SEBI. So this is time waste, yes or no? Okay. So what happens is that Y financial institution will purchase the participating notes from X. Ready my point? For example, X, myself is the X financial institution. I have already registered with SEBI. Okay. Now the Y, you are the Y. Okay, you also have financial institution. You wanted to invest in Indian stock market. But what is the condition? You have to get registered with SEBI. Only a registered financial institution, registered foreign institutional investor can invest in Indian stock market. Foreign institutional investor, only registered. So X is already registered, myself already registered with SEBI. I'm an individual. But what I'm saying is, let us assume I'm a foreign institutional investor. Okay. So foreign mutual fund. I have already registered with SEBI and I can invest in Indian stock market. Now the point is, you also what? You are also a foreign institutional investor. You wanted to invest in Indian stock market, but you have not yet registered with SEBI. Now, myself, already registered foreign institutional investor, will issue participatory notes. Participatory notes to overseas investors. Overseas investor, not just the foreign institutional investor, for anyone. For anyone, I will issue what? A participatory note. Whoever willing to invest in Indian stock market, I will issue them what? Participatory note. So what is the advantage? They need not get registered with SEBI. Clear? Done. So any dividend or capital gains collected from the underlying securities, who will collect the dividend and capital gain? Myself, foreign institutional investor. Registered foreign institutional investor will collect dividend and capital gain from the underlying shares. Okay, and will pay off to the overseas investors who bought the participatory notes. Done. Since international access to the Indian capital market is limited in foreign institutional investors, the market has found a way to circumvent this by creating the device called participatory note. Are you getting my point? For Indian capital market, the international access is limited. So that's why what this participatory note is created. So that what every investor who wanted to invest in Indian stock market need not get registered with SEBI. Clear? Because instead of asking information from everybody, Indian stock market SEBI will collect information from what? A registered foreign institutional investor. Hedge funds which invest through participatory notes borrow money cheaply from Western markets and invest these funds into stocks in emerging markets. Simple. Participatory notes are issued to the real investors on the basis of stocks purchased by foreign institutional investors. The registered FII looks after all the transactions which appear as proprietary trade in its books. It is not obligatory for the FIIs to disclose their client details to the SEBI unless asked specifically. Are you getting my point? Who are all investing in FII need not be disclosed to SEBI unless asked by specifically. Clear? So whoever, so the overseas investor, anybody can invest in what? FII. FII will issue what? Participatory notes. Done? Am I clear? Last concept. Okay, we came to an end. Who can invest in participatory notes? This you have to remember. Any entity incorporated in jurisdiction that requires filing of constitutional documents with the ROC. Any entity that is regulated, authorized or supervised by a central bank such as Bank of England, Federal Reserve, Hong Kong Monetary Authority, the Monetary Authority of Singapore. So less chances of asking this question, but they might ask you to write short notes on participatory notes. Any entity that is regulated, authorized or supervised by Securities or Futures Commission such as Foreign Services Authority. Any entity. Clear? Any entity that is a member of securities or future exchanges such as New York Stock Exchange, London Stock Exchange. Any entity that is a member can make an investment. Any individual such as fund, trust, collective investment scheme, investment company, limited partnership, whose investment advisory function is managed by an entity satisfying the criteria of A, B, C, or D. An individual can also make an investment, but his investment must be managed by an entity. So we discussed above. That means that entity must be a member of security or futures exchanges, or at least that entity must be regulated or authorized or supervised by Securities or Futures Commission, etc. Clear? Only these people can make investment in participatory notes. Done. Clear? With this we have completed what? International financial environment. So let us discuss multiple choice questions also. Let us see the multiple choice questions of a study material. Which of the following bonds are denominated in N? So here the answer, the question is, there is a printing mistake actually. The D must be both B and C, not both A and C, both B and C. So the right answer is Samurai and Shibosai. Both are the bonds denominated in N. Shibosai is what? It is privately placed. That is the only difference. Next, dash or the underwritten and have a maturity of up to 1 year. Note issuance facility is having a maturity of 1 to 1 year. They are underwritten as well as maturity is up to 1 year. Of course, commercial paper is also will have a short term. But whereas in study material they haven't specifically mentioned what maturity 1 year. Okay. Next, dash is a private arrangement between lending bank and borrower. So club loan is a arrangement between what? Lending bank and borrower. Yes or no? Small amount of loan. Next, parties must be familiar. Yes or no? Next, Anki bond is Anki bond. Here there was a printing mistake in study material. Fourth point, Anki bond is a dollar denominated bond issued in US by a non-US entity. Dollar denominated bond issued by what? Non-US entity. Bulldog bond is pound denominated bond issued in UK. Bulldog bond. Shibosai bond. Shibosai bond is denominated in Japanese yen and issued under private placement. Issued under what? Private placement. Am I clear? Okay. So denominated in Japanese yen and what? Issued under private placement. If it is denominated in Japanese yen and issued by overseas corporate to the public in Japan, then it is called what? Samurai bond. Done. With this we have completed what? Multiple choice questions. Clear? Done. And the most expected questions in this IFM chapter is, they might ask you the types of foreign bonds and they might ask you write about warrant, okay, euro convertible bond or participatory notes. Clear?